will see a price increase, and that's certainly something we need to discuss with our customers. And we are already in talks with customers on this issue. So that's, I would say, the major impact that we're seeing right now. However, as said, as the Iran war might drag on, there will certainly be other effects as well that we need to take into account.
When you say you're in talks with customers, are you flagging that you might potentially need to change contracts?
Well, certainly we need to discuss sort of how this price increase on the logistical side will be sort of transferred or split between the customers and us. So that's the whole point of the discussion right now, given that the sharp increase in fuel cost, both for vessels overseas, but also trucks and trains.
Gunnar, a very difficult time. Are you also considering cost cuts, maybe adjusting production or taking other measures to protect margins on your internal end?
Yeah, absolutely, absolutely. So what we have done already in 2025, we have focused very much on the resilience of the company. We have reduced costs. We have performed our performance program, Performance 2028. We have taken out roughly 130 million in cost in 2025 alone, and we'll continue that program forward. We will focus on infrastructure because given sort of all the infrastructure packages that we have seen in Europe, especially in Germany, there will be demand on the infrastructure side. And we also focus on defense. We have broadened our offerings on the defense side, so also see some growth opportunities here. Limited though in terms of volume, but certainly worth it. So that's why we have not only looked at cost reduction, but also in shifts in production to be able to move towards higher margin products.
Gunnar, one of the knock-on effects, of course, is that market started pricing in rate hikes and an incredible 3 from the ECB currently this year. What are you anticipating in terms of a knock-on effect on sectors like construction, for example, and might you move away from construction more towards defence should this continue for longer?
Well, certainly we have to see how this affects especially construction. So we have seen sort of the bottom out of the low market in construction in Q4 last year. We have seen a slight pickup. So far, we haven't seen the market changing due to those developments, but certainly something we have to watch out closely for. However, given the infrastructure packages that especially Germany has put forward, that will come into effect, in my view, visible for us in the second half of 26, and then further in 2027, we see still a good market for construction starting this year and then going forward. But certainly we have to see sort of how this whole situation unfolds. Pretty early in the process to have a final view on that right now. It will have an impact, though. Yes.
Gunnar, are you seeing any adjustments from customers, particularly automotive customers, already, or is everybody waiting to see how long this lasts?
I think that's the latter. We're still sort of in this trying to understand mode. So what does it do? How does it impact? And again, the closure of the Strait of Hormuz would predominantly affect oil and gas, so the energy side of things, and how that then unfolds for our customers' industries. We need to see some of the industries are not that much dependent on the energy prices, so there the impact might be limited. On the automotive side, certainly something we have to monitor, because their customers will certainly then have a specific view on that. But that might also then help with the shift towards electric vehicles. That's then sort of the natural hedge, if you want to say so, to this war.
Well, Gunnar, thank you so much for joining us today, and congratulations on the quarter. Gunnar Grubler is CEO of Xauusd. Now to some other stories we're following. You're looking at live pictures now from New York's LaGuardia Airport. That's where an Air Canada Express flight collided with an airport ground vehicle shortly after landing yesterday. It's the latest in a series of incidents that have put aviation safety in the spotlight. NBC reports that 80 people were on board and at least 4 have been injured. LaGuardia Airport has been closed to incoming flights. EasyJet is being demoted from the FTSE 100 after a sustained drop in its share price. The budget airline fell to its lowest since November of 2023 last week. It was already under pressure before the Iran war from price competitions. Hikma Pharmaceuticals is also dropping out, making way for Lion Finance and IG Group. Plenty more coming up. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
Sergio Armati there, the UBS Group CEO, speaking exclusively to Bloomberg. Let's have a look at these terminals, because in this one you can see the path policy projections for the Federal Reserve and the unwind, the incredible unwind just since the end of February, which is the blue line, right? And this is where we are today at the yellow line. So that's all of those cuts coming out and potentially some hikes being priced in. Let's take a look at LNG now, because basically exports have stopped. It's really incredible. If you look at UAE and Qatar, their LNG exports are literally at zero at the moment, and that's contributing to a 6-month low for LNG exports entirely. And then with gold and volatility, we might be seeing equity volatility coming up to meet gold volatility, but right now gold volatility is still outpacing equity volatility by quite the margin. Coming up, Sheryl Sandberg, the former Meta COO, she's going to be on Bloomberg ETF IQ. That's at 4 p.m. London time. Don't miss that interview. Do stay with us, though. The opening trade is up next. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Good morning. It's Monday, March 23rd. Here's what's on the agenda. Stocks and bonds drop as the US and Iran harden their rhetoric. Oil prices climb with President Trump's Xauusd deadline approaching. And gold sinks on deepening inflation concerns.
All of that weighing on equity market futures then this morning. Lizzie, the European futures picture looks pretty negative this Monday morning, down by 1.9% on Euro Stoxx 50 futures. Some of the underlying markets there already in correction territory as we see threat and counter threat traded by the US and the Iranians. The markets see no off-ramp. They see just escalation, and that weighs on sentiment. S&P futures also down by 0.9%. NASDAQ futures now down by 1%. Brent crude up only 1%, you might say, given the context and the rhetoric we've seen over the weekend. But of course, it's up 50% since February, and further out the curve, you see quite a lot more response on the Brent price this morning. The countdown to the opening trade starts right now.
We're now in the 4th week of the Middle East war. Traders dealing with fatigue, volatility, and confusing signals, frankly, out of the White House. President Trump said that he was thinking about winding down military operations against Tehran, and then he gave a 48-hour deadline to Iran until just before midnight in London tonight, in fact, to reopen the Strait of Hormuz or have its plants bombed. So, Anna, the stock sell-off continues. You've seen Asian shares down for a 3rd day, set to enter a correction. Futures down on both sides of the Atlantic. Global bond yields at their highest level in years in anticipation of rate hikes, and the dollar up on President Trump's latest threats.
Yeah, the narrative has shifted a bit over the weekend. To your point, Lizzie, Saturday we got a slightly more conciliatory tone from President Trump, talking about, dialing things back. And then today things don't look that way. President Trump saying to the Iranians, you've got a 2-day deadline. That was on Saturday. As you say, late Monday is when that expires. Open the strait or we bomb your power plants. Essentially, the Iranians say if you bomb our power plants, then we take aim at energy technology and desalination infrastructure within the region that's backed by the US and Israel. So the rhetoric continues, escalation continues, stocks drop. We are looking at futures that are pretty negative for Europe, but also for the United States. And I think that's interesting. But that really does follow on from Friday, where we saw considerable negativity around risk assets and a real rise in bond yields. Some of the moves higher in the yields. 10-year Italian BTPs, the yield up 18 basis points, gilts up 14 basis points. And it wasn't just, that's the 10-year, the 2-year showing some elevation as well on the yields, but it wasn't just the short end. It was the whole of the curve in focus for European bond markets and to some degree going global.
Yeah, the question being how much does this become not just an inflation crisis, but also a growth crisis the more that this progresses? Look, when it comes to what happens next in the Middle East, some analysts saying that Trump's in a corner here because it's highly unlikely that Iran is going to agree to his terms on such an accelerated timeline under the threat of attack. So we just have to watch towards that almost midnight deadline tonight for what happens next.
Yeah, absolutely. A lot of the analysts looking at the incentives that Iran faces right now and asking, do they really have any incentive to open the Strait of Hormuz, and certainly suggesting that they won't. And that takes us on to commodities. Commodities, of course, the epicenter of the supply chain disruption and energy crisis that we're now seeing here. And as I mentioned a moment ago, Brent prices are higher, up by 1% on Brent. WTI has perhaps notably, given the president's focus on higher energy prices, gone above $100 a barrel. So we keep that in mind. And we are seeing actually WTI responding more than Brent at the short end of the oil curves. Further out the curve, you see more response in Brent, though, as if the market has taken the weekend to think about, yes, we knew about the short-term risk to supply, but now we're prepared to think about the duration of these disruptions and what that means for energy prices further out. So that is something of a focus.
Yeah, Goldman's raised its 2026 Brent forecast to $85 a barrel from $77. But some analysts are saying it's not going to drop back to where it was, even if the Strait of Hormuz reopens, because a security premium will have to be baked in. Some analysts saying to go higher from here, it's going to take something tangible. We've talked a lot about the rhetoric on both sides hotting up, but analysts saying it's going to take more than an escalation of rhetoric for the price to climb again. It'll be broader issues with shipping or insurance. But of course, all of this is the backdrop to CERAWeek that's happening in Houston. The war obviously going to dominate discussions in the oil industry, but we report that the Aramco CEO isn't going to be there because he's having to deal, obviously, with the situation in the Middle East.
Yeah, something more pressing at home to deal with. And we've heard from the IEA, the Energy Authority, the Energy Agency, of course, and they have their assessments of what kind of damage we've seen to energy infrastructure in the Middle East. And this is really important to that futures curve, to the duration of the disruption that analysts are expecting. He's talking about, this is Fatih Birol, talking about more than 40 assets at risk of severe or very severe damage in the region. He then gives the context around how big is this versus 2022 versus energy shocks in the 1970s. He says we're facing the largest energy shock we've ever faced. He says this is 2 times bigger than what we saw in the 1970s and the 2022 energy shock, all of that combined. So certainly upping the ante when it comes to the scale of what we're witnessing here.
So we've seen higher oil prices, but we've also seen the price of US gasoline, fertilizer and many metals climbing because of the continued effective closure of the Strait of Hormuz. But also, on the flip side, gold down. So nearly 3% down, close to wiping out its gains for the year, which is strange, isn't it, when we take a step back and consider that we are in the middle of a war, we're facing potential stagflation, but it appears that traders have been selling to cover their losses elsewhere in their portfolios. And there's a great column by Edward Harrison in his Macro View saying that this is potentially a harbinger of more generalised profit-taking, but the question being whether gold comes back when this sell the winners phenomenon is done.
Yeah, it's interesting. Bond markets, we've seen them very much reflecting inflation concerns, and that seems to be doing damage to gold. If the bond markets story flipped and we started worrying about growth concerns, would we see something different in metals markets as well? Because we have those that sort of inflation everywhere concern, higher for longer rates, and all of that. If you're going to get higher rates on all kinds of assets around the world, then maybe you don't need gold so much, or gold which doesn't pay you that coupon, maybe that doesn't look correct. So appealing the opportunity of cost of holding it doesn't look so good. You add to that the fact that it had done just so well, that and silver running into this, and of course it is very liquid, and we have another day of quite substantial losses on gold and on silver, both down 7.5%, 8.5% right now. So ongoing focus on what's going on with metals.
Yeah, interesting that silver and the Kospi have moved in lockstep as favoured trades for retail investors. Silver's drawdown approaching 30%, and today you're looking at the Kospi just going right back to where we started with equities. The Kospi down 6.5% right now.
Yeah, absolutely. So the Kospi and Japanese markets, the epicentre of the selling, the MSCI Asia Pacific down by 3.7% at this point. Let us tell you what is coming up on the programme. We have assembled a great roster of guests to talk to about all of these market dynamics. Pooja Kumra joins us, TD Securities Senior European and UK Rate Strategist. Incredible moves really on Friday. How much will we see that continue today, or will there be a line in the sand? Maria Minucci, M&G Investment Multi-Asset Fund Manager. Where on earth do you try and position your portfolio? How do you find any safety right now? Mark Giannoni will be with us, Barclays Chief US Economist in town. So really good to get his perspective as to what damage to expect for the US economy and what the Fed does with potentially new leadership on the horizon.
Let's take a look at what else we're watching throughout the week. Today we have Ursula von der Leyen visiting Australia. We also have CERAWeek kicking off, as we mentioned. Then tomorrow, lots of global PMIs dropping, plus Denmark's snap general election. Then on Wednesday, we get UK CPI, the expectation being that slowdown in inflation will stop at 3% in February. On Thursday, we have the G7 foreign ministers meeting, as well as the OECD interim economic outlook. And then on Friday, the University of Michigan Consumer Sentiment Survey, as well as Spanish CPI. But these PMIs really in focus this week. The global economy's first health check really since the war broke out. So an interesting afterthought to the central bank decisions last week, and a bit more of a read on how economies are faring when a lot of those projections that central banks put out were already out of date on publication.
Yeah, absolutely. And you wonder how much of the forward-looking stuff is reflected in these PMIs. You know, how much are purchasing managers nervous about the future, thinking about their supply chains? You would think to quite a high degree, wouldn't you? But actually looking at the estimates, the things that we're expecting from PMIs, yes, we're expecting a bit of a retreat across the Eurozone, France, Germany and the UK data also. But we're not really expecting a dramatic drop back in this PMI data, which I think in itself is quite interesting. I mean, the ZEW, sure, that's investor expectations. It's not business leaders. But that really tanked. And so if that in any sense filters through into this PMI data, then maybe we're up for something a bit more negative.
Yeah, that could add to the volatility. You've also got CPI, as I say, in the UK. That'll get a lot of attention after the gilt yield moves that you mentioned last week. But speaking of the UK, important today, we have the Prime Minister meeting senior ministers as well as the Bank of England Governor Andrew Bailey to talk about the Iran crisis and what happens next. They'll talk about energy security, they'll talk about supply chain resilience, and also the international response to the war, because of course so much pressure from the White House on Keir Starmer to get more actively involved.
And it seems like a lot of the European narratives have turned to, well, what can these European governments do to help their populations cope with higher energy costs? The extent to which they're able to move on that subject is interesting versus 2022, where we saw quite a lot of support rolled out for households and bond markets. The extent to which they will tolerate any higher spending and higher indebtedness is certainly something we will keep watching. 10 minutes past 7 here in London, Monday 23rd of March. Let's get up to date on some of the other stories that we're following for you this morning. LaGuardia Airport has been closed to incoming flights on Sunday after an Air Canada Express flight collided with a vehicle shortly after landing. Police say the aircraft hit a Port Authority of New York and New Jersey ground vehicle. Images circulating on social media appear to show an Air Canada plane tilted on its tail with the nose of the aircraft ripped off. NBC News is reporting that both the pilot and co-pilot died in the collision. German Conservatives, led by Chancellor Friedrich Merz, have dislodged the Social Democrats from power in a southwestern state after 35 years. The win comes as Merz struggles to gain nationwide traction among voters. Meanwhile, over in France, Marine Le Pen's national rally fell short in its bid to take control of a host of major French cities in Sunday's municipal election. In Paris, the socialist Emmanuel Grégoire is on course to win the race for mayor, extending the left's quarter-century hold on the French capital. And Poste Italienne says it will launch a voluntary public offer for Telecom Italia, valued at about 10.8 billion euros. The cash and share issue would see Poste Italienne take full control of the former phone monopoly, setting up its delisting. The offer is at a 9% premium to Telecom Italia's closing price on Friday.
Coming up on the programme, UBS CEO Sergio Emotti says energy prices are likely to stay elevated as investors digest the impact of the Iran war. We'll bring you some of that exclusive interview later on in the show. Plus, the IEA reveals more than 40 energy sites have been damaged in the war. We'll discuss the implications for the sector. But up next, we'll be joined by Kit Dukes, Chief FX Strategist at Societe Generale. If you've got any questions of your own for our guests, please do send them in to us on IB plus BBTV Go. Good morning from London. This is Bloomberg.
the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Welcome back, everybody. 45 minutes and then until the start of cash equities trading here in Europe, and we are seeing the effects of the threats we've seen from the US and Iran, each of them threatening each other over the weekend, and as a result, equity market futures are once again negative. The US and Iran trading threats then as the conflict enters its fourth week, showing no signs of de-escalating. US President Donald Trump issued Iran a 2-day deadline. That was on Saturday to reopen the Strait of Hormuz or face its power plants being bombed. That expires Monday evening European time. Iran countered that it would close the strait completely if its power facilities are attacked. Treasury Secretary Scott Bessent told NBC's Meet the Press that Hormuz is in its sights, with the US aiming to destroy Iran's fortifications along the strait.
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate.
Let's get analysis from the region. Bloomberg's Jemana Bersecci joins us from Dubai. Jemana, good morning. So what is the latest then as we approach President Trump's deadline later today?
Well, Treasury Secretary Scott Bessent there framing it as sometimes you have to escalate to de-escalate, and that is exactly the situation that we may be in the coming 24 hours. I'm referring to the post that President Trump put up over the weekend, specifically at 7:44 p.m. on Saturday. And the reason I cite that time is because he's basically given Iran a 48-hour ultimatum to reopen the straits without threat, or else, he says, the U.S. will hit and obliterate various power plants, starting with the biggest one first. And Iran has around 100 power plants that they're sitting on that could potentially be targets. Now, Iran were quick to retaliate as ever. And they said that if that does happen, and if civilian infrastructure is targeted, then they, in turn, will strike back on all energy, information technology, and desalination infrastructure linked to the U.S. and Israel in the region. And so what we're sitting on here now is sort of wait and see to see whether the U.S. administration, whether Trump actually acts on that ultimatum. We expect that to occur at some point in the middle of the night, the 48-hour window. But overnight as well, Iran went one step further. The Speaker of the Parliament also put out a post suggesting that any U.S. financial institution that also has bought U.S. treasuries may also be deemed a risk as well. So lots of this very harsh rhetoric coming through from Iran about a potential escalation even further and potentially more structural and targeted strikes on key infrastructure around the region. And so as we enter into day 24 of this war, Anna, really no signs at all that things are de-escalating. In fact, quite the opposite. And just to add to that, there were also reports emerging on Friday that the U.S. administration is weighing up sending around 2,000 to 3,000 Marines to the Persian Gulf alongside the potential takeover of Karg Island as well. And if that does happen, that's all going to play out over the series of weeks, not necessarily days, which also implies that what we're settling in for now is another few weeks of this at the very least, as opposed to a conflict that could be resolved in the coming days, or as President Trump suggested on Friday, that they would be looking to wind down soon.
Okay. Jomana Basechi out of Dubai, thank you very much for the update. Well, let's play out how all of this is going to happen in the market. Particularly in currencies. We're joined now by Kit Jukes, Chief FX Strategist over at Societe Generale. Kit, welcome back. So you heard Jomana there. We've got the dollar up again this morning. I wonder how much further it has to run if this war continues for another few weeks, and with Fed hikes, I should say, looking more likely.
Well, I think it can run quite a long way in a sense. I mean, yeah, I can't imagine wanting to own this morning a currency of a country that wasn't an oil producer, to put it really, really simply. In other words, you take the example of Australia, just about the most fashionable currency so far this year. Market's still long of it last week. They have about, I think, 30 days worth of oil reserves. So you turn around and say, well, if we do this for another 30 days, for example, they have a big problem, in the sense of they have, LNG, but I have pictures in my mind of people in the outback and trucks driving around, and it's not going to work very well. You can't cycle around Australia much. So I think that's a real threat for even the most attractive currencies if this goes on. So the dollar's fine, the Norwegian kroner's fine, the Canadian dollar's fine. The rest of us, we have a completely different set of problems if this lasts for 2 months relative to 1 month.
And this might sound far-fetched given what Jomana was just saying, but let's say at the end of this 48-hour deadline from President Trump that Iran were to reopen the Strait of Hormuz. Would the dollar reverse the gains that we've seen, or would it just be a pause?
You'd pause for a bit, because this is too fluid a situation to be able to turn around and say, yeah, everything's good now. It's kind of in a bit the same. We're not going to get oil prices to suddenly fall back a really long way. But there is a material, for me there's a difference not so much with the oil price and what it does as the availability, because we're taking a big hunk of global supply of oil out, and without that, someone's not going to have any. I mean, that's the sort of end game. If it's more expensive for longer, if we settle at $90 a barrel for a significant length of time, the dollar doesn't go up, that much on the back of that. That's a different story. So it's very fluid in the sense that this will end one day, and the outlook will change immediately. As of this morning, I don't care almost what the Fed does. They are a big oil producer, and that makes all the world of difference.
Okay, and that is what, as you say, what the market seems to be focused on in terms of FX, tangential to FX, but I wonder your views on it, Kit. We see big moves in metals prices and precious metals in particular. So silver down by 9.6% right now, gold down by 8.7%. That's just in today's session. So once again, we're seeing the markets selling the things that have done well, selling the things that are really liquid, and perhaps spooked by inflation once again, and that's the result. What do you think drives this, and how much further does this trend have to run?
You can go further. I mean, I think Mike Haig, my commodities colleague, will be on later, who is much wiser. But I do have a sense that some people have been using gold in particular to sell their gold's gone up a lot in order to buy more expensive oil and things like that in the short run to kind of get hold of supply. So, some of this is just practical. It's gone up a lot, and that's gone up a lot, and I can just shuffle some because I need this now. I don't think the long-term story for precious metals is going to change that much. I don't think that people will go on writing articles about the dollar's position in portfolios and a fragmented world and uncertainty.
That's why I asked you really, because before we got into this Iran war, Kit, the story was around, well, the question being asked at least was to what extent were we going to see de-dollarization, and were gold and silver going to be the beneficiaries of that?
And even on Friday, people were asking, should I be selling the dollar now because they're creating so much uncertainty that I don't want to buy treasuries? I think there's an argument that the rest of the world has invested so much money in the United States, and this presidency's caused so much uncertainty that some people would like one day to have less of their money invested in US assets. But that feels like, yes, that's a nice theoretical position, not today's issue.
And in the moment, you just refer them to the fact they produce oil and energy, and that's the way we started the conversation.
Can I come back to central banks, but more so in Europe? Because we had quite hawkish language from the Bank of England, perhaps compared to the ECB, and yet you saw the pound weakening against the euro by the end of the week. Do you think that's a reflection of traders perhaps not really believing that the Bank of England can hike rates when the growth backdrop is weak?
Yeah, I think to some extent the growth backdrop's more important than the rate backdrop. I don't just buy UK assets because we have higher rates. I mean, clearly they help, but it feels as if you're seeing forecasts for the UK economy come down to 0.3, 0.4% from some people already now. It feels as if this goes on for a long time, we're going to have a very ugly position that's going to turn into an ugly fiscal position, and that's going to turn into a problem that then I don't care what interest rates are if we're going to start really worrying about the long end of the gilt market again and things like that. So I'm not surprised that it didn't react so positively to that. Again, it looks as if the Bank of England is closer to raising rates than some. I can't believe that would help the economy right now, and it's not that great already.
Yeah, I mean, we do seem to be worrying a lot about inflation right now for obvious reasons, Kit. And as if we can't maybe worry about inflation and growth at the same time, should we be doing more of the latter?
I mean, the UK has a difficult growth inflation trade-off at the moment. And Hugh Pill mentions it, I think, in almost every single set of minutes, that he's uncomfortable that the neutral rate and things are going up. And so he's sort of been banging on about it quietly in his corner for 12 months. And if you kind of take that, you say, well, yeah, it's not a great picture for a currency if you're telling me my growth inflation trade-off's bad and my neutral interest rates sort of higher. You're not making me invest masses of my excess money in the UK until I get to the point where I say, look, nothing else really matters. You're offering me yields on gilts that I know they're not going to default. Let's not be silly. My pension's going into it.
Kit, thank you very much. Thanks for bringing us your thoughts this morning. Kit Xauusd, Chief FX Strategist at Societe Generale. Lots more to talk about when it comes to bond markets. Coming up, global bond yields climb due to angst around the Iran conflict and its impact on central bank rate paths. We're actually seeing European bond markets just opening up this morning, and we are going a little bit higher. Certainly in France, I can see that the yield is a little higher. In Germany as well, and in Spain, those markets now open. Of course, the UK market not yet open. We'll see what that does in around 35 minutes time when we get the gilt open. We'll talk to Pooja Kumra about all of that, senior European and UK rate strategist at TD Securities. That conversation coming up next here on the opening trade. This is Bloomberg.
at Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. This is the opening trade. 30 minutes this Monday morning until the start of cash equities trading, and we are going to feel the effects of the rhetoric from the US to Iran and back again. That is going to weigh on equity markets at the start of the European trading day. Some of this goes back to Friday's session in the States because we had US equities down considerably on Friday, Lizzie, toward the end of the session, and we need to catch up with that. But US futures also pointing lower, incidentally, down by 1% on E-minis and on NASDAQ futures. But Europe, for the moment, will be in the crosshairs.
Yeah, yields higher stateside on treasuries across the curve. But if we look at the European bond space, we also have yields higher across the continent, across the curve. Investors, of course, increasingly concerned about inflation as a product of the war. That upending rate expectations. But do note here, you've got the French 10-year yield higher 5 basis points. We've just had those local elections in France, the far right missing the key targets in those municipal elections. We'll get more on why this reaction has been the product of that in just a moment.
Yeah, in fact, let's go to that, shall we? Joining us now, Pooja Kumar, Senior European and UK Rate Strategist at TD Securities, with us this morning. Pooja, good morning. So, Lizzie, just been through some of the movements we've seen in bond markets this morning. During Friday's session, we seem to see almost across the board higher yields, not quite everywhere, but a lot of higher yields across Europe, and a lot of different parts of the curve as well, not just the sort of short end. Today we see some more of that, but in particular France and Italy, where we see yield spreads, I should say, widening. What's happening? Let's stick with the France story for a moment, because of course we've got this political dimension. Is it the politics that pushes that yield higher this morning, or is it the broader Iran narrative?
I would say it's more of the broader Iran narrative. I think French political situation is very well known for markets, and we still have a long way to go towards the election. But what we are seeing right now is the widening of EGB spreads, the tightening of financial conditions across the board when it comes to Europe. Like BTP versus bonds actually is, we had it trading around 60 basis points ahead of this crisis. And, we have seen that when we do see a hawkish narrative from ECB, this spread should widen, right? People buy these products just because we know we have a central bank that's been easing rates. So I think that's the narrative that's actually driving the spreads wider across the EGB space right now.
Yes, I mean, when do you start to be nervous about the Italian BTP bund spread, Pooja? Where are we? We're at 97 right now.
No, for me, actually, the 100 basis points was the critical level, and that was one level that I was just discussing on Friday, and we are inching that level very quickly. I think at 100, it is getting something that ECB cannot ignore. Again, it's not that high from a historic perspective, but the fact that the crisis is going so quickly and the fact that markets are actually pricing in 80 basis points in hikes from ECB is very punchy, right? And I think this is something that even Lagarde said, that the starting point for this crisis is very different from 2022, right? The real yields are at a very different level. We don't have that kind of free liquidity in the European or the UK market right now that we had in 2022. So for us to actually think that ECB can hike 80 basis points in this environment, it's a bit too aggressive.
Okay, so April not live for you when it comes to the ECB, even though they've got a better growth backdrop than the Bank of England.
Well, we are eroding the growth backdrop, right, with this entire move in rates that we are seeing in the tighter financial conditions. Again, it's hard to say anything because, it's been 3 weeks and day by day the crisis is just getting worse, right? First week we never thought we'll be at this level. So for us, it just makes sense for them to actually wait for the next forecast than overreacting, because the verbal part of the tightening in financial conditions is happening, right? For them, the key is to make sure inflation is anchored, and I think that's what they tried doing during the last week's conference.
Let's talk about the BOE as well. They've kind of shelved the easing plans. They've declared themselves ready to act. You've seen 10-year yields ending Friday 15 basis points higher. It's the highest close since 2008. We're waiting for them to open this morning. If you've got higher rates paired with fiscal largesse, which arguably the UK can't afford, how much higher do gilt yields climb?
Gilts is pretty much coming in a very weak picture right now. So far, I think it was all about the monetary policy last week. But I think right now we will actually, if we climb higher than the 5% level for 10-year, the concerns are more fiscal, to your point, right? So whatever the OBR fiscal buffers for 23 billion, they can be actually wiped out very quickly. A 1% move in gilt yields can wipe out around 18 billion in terms of these buffers, right? So that is eroding quickly. So for me, the key risk right now is that from a monetary standpoint, we have seen the bear flattening because everyone was pricing in hikes from BOE. This could turn into a bear steepening if markets actually think about the fiscal concerns returning back again, and the Rachel Reeves has to come back to this market again. But I'm hoping we don't reach that level. But 5% for us is definitely a very crucial hit when it comes to 10-year gilts.
Okay, so we'll keep an eye in 25 minutes' time when we get the open of gilt markets then, Peter, and what happens there. What about the central bank reaction function widely across Europe that you're expecting to see here? We heard a lot of tough talk last week. The purpose of that tough talk is perhaps, as you said, to try and keep a lid on inflation, to try and have the markets maybe do some of the central bank's tightening work for it. Is that the purpose of it? The more they talk tough, the less they maybe have to follow through with those hikes. Is that the idea?
Certainly, I think that was the first plan of action for most central banks who have been hit by inflation. I think BOE was something that markets really did not expect. That I think it was the first time since 2021 that they have voted unanimously for not doing anything, right? So for me, they would like this to work, but this week we will see first set of PMI, something that you mentioned, and that will also show that the economy is weak. So it is getting a very different, even the central banks cannot play the same playbook that we had in 2022 because growth is not at the same footing. For Europe as well, right? Germany has its fiscal buffers, but we are seeing weaker growth elsewhere.
And you had the Fed sounding a little bit less hawkish than the ECB and the Bank of England. How much would that, to some extent, put a lid on the dollar's gains from here on out?
I think at this stage, when you have something like a global event like this, dollar does get the dominance trade, and that's likely to continue unless, I don't think we are going back to the liberalization trade right now. So that dominance is still going to continue, and what we are doing right now is basically markets putting in those kind of hikes in US as well, right? Like if you see the front end, we almost sold off 60 basis points. We were cutting, we were pricing in 50 basis points in cuts, and now almost 10 basis points in hikes. So we are looking for dollar dominance to continue. especially given the fact that Europe and UK are clear net importers of oil. They do have a current deficits that they have to deal with. So that gives US much more of a stronger position here.
Okay, Pooja, great to have you back. Pooja Kumra there, Senior European and UK Rate Strategist over at TD Securities. Thank you. Well, we began with the politics. German Conservatives, led by Chancellor Friedrich Merz, have secured an election win in a socialist haven as he struggles to gain traction among voters. Meanwhile, in France, the far right fell short of taking control of some major cities during yesterday's municipal elections. Let's bring in now Oliver Crook, Bloomberg's chief Europe correspondent, to take us through some of those results. Ollie, good morning. So let's start with Germany. The victory softens the blow for the CDU after quite a stinging defeat in a neighbouring state. Tell us more.
Yeah, I think that's fair to say, Lizzie. That said, Rheinland-Pfalz, where the election was held over the weekend, is a much smaller state than Baden-Württemberg, where the CDU was supposed to win 2 weeks ago and, of course, then got edged out by the Greens. You know, another sort of blow to Friedrich Merz, who we have to say is a fairly unpopular politician who failed to get the votes of his own coalition lawmakers to get him into the premiership on the first day, which was supposed to be a rubber stamp vote. So this is really taken as a welcome win victory for the Chancellor of Germany. That being said, I'm not sure how much we can read into it. The party that he beat, that he edged out, the SPD, which we should say was in power for about 35 years, so significant. It's also their junior coalition partner, so they're also part of this government. We should also say that in this vote as well, we had the AfD get about 20% of the vote. That was a record for them, and that is not generally an area of Germany where they tend to be dominant. That being said, again, trying to add up all of these sort of slight victories for the Chancellor of Germany, who's had a real difficulty getting his political messages to cut through, really difficulty for all the issues that have been adding up for the German economy. So he'll take that as a win. That being said, I don't think that macro speaking, in terms of the political picture within Germany, it changes things that dramatically.
Okay, so that's the nuance there in Germany, Ollie. How about over in France? Marine Le Pen's national rally missed out on some of its biggest targets over the weekend in some local elections there. What does this mean ahead of next year's presidential election?
Yeah, I think everyone's watching this very closely. So these are municipal elections across much of France. And we should say that really the big piece of news was in Paris. Of course, this is the most sort of important city in France, a very sort of centrist, or I should say a very sort of centralized political structure within France. And it was the socialists that retained power there. Emmanuel Grégoire, who will take over from Anne Hidalgo as mayor of Paris after she was in power for about 12 years. So the socialists remain in power there. That being said, across France, what we've seen is sort of an interesting picture here, where you did see the far right, the Rassemblement National, Marine Le Pen's party, headed by Jordan Bardella. They did gain significantly across the sort of aggregate in terms of popularity across France. That being said, as you mentioned, Anna, they failed to win a lot of the key cities that they wanted to sort of take power in. So they potentially did not get the kind of momentum to get them in power. So we're watching this obviously very closely ahead of 2027, the end of the age of Macron. And Macron's really big political feat was collapsing the center of French politics with the socialists and the right Républicain. Those all sort of went and flocked towards Macron and basically destroyed those parties significantly going into this election now in 2027, where it's anybody's game. Unlike Germany, in France, you know, it's a presidential system. There are these 2 rounds of voting. It's a lot more volatile, much harder to predict. It's, you know, watch very closely to see what we can get in 2027. That being said, 2027 is a long way away, particularly in French politics. But again, the sort of broad picture here is that the far right is doing better in France, but not really cutting through to the point of being able to win those key municipalities.
Ollie, thanks very much. Bloomberg's chief Europe correspondent Oliver Crook with the latest on those political dynamics. And politicians all over Europe very conscious of the difficulties within the energy markets and the inflation that could unleash. The International Energy Agency's executive director, Fatih Birol, has spoken about the widespread damage to energy infrastructure in the Middle East, potentially prolonging disruptions to global supply chains after the conflict ends.
We are following the damage on all the energy assets. There are at least 40 energy assets in the region are severely or very severely damaged, okay, and across 9 countries.
His assessment there. We will discuss more on the implications for the energy sector and the oil outlook later in the show. This is Bloomberg.
cidade estava sitiada.
Isso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner. I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Minutes away from the opening trade. Good morning if you're just joining us. Here's what your futures picture is looking like in Europe. We are in negative territory this morning. The DAX in Frankfurt expected to suffer the most, but we've already seen losses in the Asian session and we're expected to see them as well in the US session. At the same time, we've just seen traders boosting their bets on ECB rate hikes this year. They now see a 50% chance of 4 hikes in 2026. So in the bond space, we're seeing yields higher across the curve, across the continent, Anna.
Yeah, absolutely. Let's talk about what's happening in these markets. Our Markets Live executive editor, Mark Cudmore, joins us now with more. Mark, let me start with precious metals, because we see gold and silver prices both down by around 6% right now on my Bloomberg screen. I mean, does this strike you as interesting, a continuation, really, of what we already knew about the role that gold and silver were playing in this particular war, in this particular crisis? But I guess it's interesting that this is happening once again, another Monday, where this is the knee-jerk reaction.
Yeah, good morning, Anna. We're certainly seeing some short-term capitulation type price action in precious metals and some other assets out there. I don't think that this is the low, though. You know, as we've discussed a lot over the last couple of weeks, this should be a very negative environment for gold. All the marginal factors switched at the start of this month. We got a stronger dollar, we got higher yields, and if you were buying gold on the risk of a war in the Middle East, well, you got your war at the start of the month, and therefore it's time to pat yourself on the back and take profit. So all those things are playing out right now. There's no further escalation that you can reasonably bet on without something that's completely doom-mongery for humanity. So I think that, you know, gold should continue to decline. Now, very short term, this action looks like we've done a lot of the short-term stop losses, but I wouldn't be surprised over the coming weeks, if the conflict continues, that we have another 10% or so downside.
Mark, what about this argument that you could see a comeback for gold when the sell the winners phenomenon is over and done with?
Well, I think gold has been selling off because of that dynamic, because the idea that, you know, it's somewhere where people have made a lot of money. You got to remember that gold, you know, while it's off whatever $1,300 or $1,400 from the highs, it's still up about, you know, $700 or more from where it was a year ago. I don't have the exact kind of rates in front of me. So it's still up over the last year, and that's the dynamic which is kind of driving this, that basically we are seeing just general deleveraging in the market. People are having to sell down their winners to pay for losers, and I think that's what's been driving gold at the moment. You know, probably after we get through the crisis and dollar starts declining again and yields start softening again, people will get back on gold. Ultimately, the long-term desire to seek alternatives to the dollar and fiat currencies is probably still valid. It's just we won't return to that until the conflict is over.
Let me ask you about stocks then, Mark, because we're 12 minutes away here from a European equity session that looks as if it's going to be pretty negative. European futures down by 1.8% right now. The Xauusd DAX, as it often does, could take the worst of that. But that's not necessarily the end of it, because US futures also pointing a little bit lower. This is starting out to be a negative session, negative week for stocks.
Yeah, look, we're having the worst month for global stocks in 3.5 years by some distance now. It's a pretty bleak month. Unfortunately, my view hasn't really changed the last few weeks. I keep on saying it's bad, it's going to get worse, and I still think that's the case. As I said, it does feel like short term there's been a little bit of capitulation, so I have no particularly strong view in the next 24 hours. But the market is still positioned very optimistically despite the sell-off. There is still a belief that the conflict will end soon, the strait will open up soon. I'm not going to tell people what's going to happen in the conflict. I don't think anyone's got a clue, including Donald Trump. So therefore, I don't know how anyone has conviction about it. What I do know is the asymmetric setup is for much more declines to come. To be contrarian right now is to stay being bearish even after these sell-offs.
Okay, Mark Cudmore there, our Markets Live executive editor. Thank you very much. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by going to MLIV Go on your terminal. Let's go to your stocks to watch now with Bloomberg's Jennifer Creary. Jennifer, what are you watching?
Good morning. We're going to kick off today with a bit of M&A action, and that comes from Poste Italiane. Poste Italiane said it will launch a voluntary public offer for Telecom Italia valued at 10.8 billion euros. Now, Poste Italiane seeking full control of Telecom Italia, and the move would set it up for a delisting. Now, the deal would turn Telecom Italia's largest shareholder into its owner. It would also bring Telecom Italia's network, cloud, and data into Poste's broader platform. Now, that move would align with Italian Prime Minister Giorgia Meloni's push for closer oversight of strategic infrastructure. So we're keeping an eye on those two stocks at the open, in particular Poste Italiane. Next up, we've talked a little bit about precious metals, and we're going to focus on the miners this morning. And that's after gold fell for the 9th day during Asia trading, reversing some of its record high gains since the start of the year. Glencore, Antofagasta, Rio Tinto, Anglo American in focus on the open, and that comes as investors are concerned over the inflationary risk arising from the Middle East conflict, as well as the prospect of higher interest rates. So we're keeping an eye on those shares as well. Finally, we're going to end on Volkswagen. That comes after the CEO said in an interview with a German newspaper that restructuring will continue. Now, as you can see, over the past year, Volkswagen has been on a very volatile ride. That comes as the car maker looks to restructure, to cut costs in light of higher competition from Chinese players, but also higher costs in the electric vehicle space. We have a quote from Oliver Boom saying that our energy costs are too high and there's too much regulation. So Volkswagen shares will also be in focus at the open. Back to you.
Jennifer, thank you very much. Jennifer Creary with a look at some of the stocks and indeed individual stocks that could be in focus. Let's think about where we are on the commodity markets then, Lizzie. We are up by 1.6% on Brent, up by 3.4% on WTI. I mean, that's interesting in itself, isn't it? It seems as if the US-focused market, the US-focused benchmark, is paying more attention to the rhetoric now than it was a couple of weeks ago. We spent a lot of last week, talking about the divergence. Maybe Brent would go higher and WTI would be a bit more insulated from that upward pressure. That does not seem to be the case this morning.
And it's interesting that you've seen wild moves in the bond market, but not so much when it comes to oil, but still 114 notable, and that could set off a risk-off mood in the European stock session today. And indeed, that's what the futures picture is suggesting we're going to get. Eurostoxx 50 futures down nearly 2% now. Particular weakness for Germany expected, but we're in the red for the FTSE, the CAC, and the FTSE MIB in Italy as well.
Yeah, absolutely. So that's where the equity markets will be heading. Thinking about where we are on these energy markets, I mean, the fact that we've got WTI now over $100 a barrel, I read at least 2 notes this morning suggesting that this might be significant for the narrative over in the US as President Trump focuses his mind on higher energy markets, energy prices a little bit. What can be done about that? I don't know. But the fact that we've gone above $100 a barrel on WTI does seem to be interesting. But the broad, as you say, the broad move is that we are not seeing enormous amounts of movement higher at the short end, at least, of these curves. So if we look at gas markets as well, natural gas price up by 4% for the Dutch benchmark this morning, which by recent standards is quite constrained. But if you look further out the curve, certainly on the Brent curve, if you look further out, you're actually seeing more movement to the upside, all the way out to 27, 29, some of these futures going higher, as if it's not necessarily a near-term conclusion that has shifted this morning. It's something about the longer term, something about the damage created in the Middle East and what that's going to do over the medium term to energy markets.
Arguably, it's because we've seen oil prices rising, even in the US, that President Trump is under so much pressure to put pressure on Tehran, to put out that Truth Social post saying, Tehran, you've got 48 hours to reopen the strait or have your plants bombed.
Yeah.
But then when Iran responds and you're seeing infrastructure damaged on both sides, on Gulf nations and Iran as well, that's what prolongs the crisis in terms of when we get back to the normal oil flows and pushes oil prices even higher.
Yeah, absolutely. So European equity market futures pointing lower, US futures still pointing lower, down by 1.1% on NASDAQ futures. We keep in mind what's happening in bond markets as well, because this can add a different complexion to the equity session as well as we wait for that to start. On the bond markets, we are seeing those yields going higher once again after some fairly substantial moves higher during Friday's session for yield. So bond selling, equity selling, it's certainly the stories of the moment. We'll be back with the opening trade for this Monday morning. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasajja in the Lesotho Highlands, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasajja, and this is Next Africa. New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back, everybody. This is the opening trade for this Monday morning, and we are expecting to see negativity at the start of the European trading day. At this time of a Monday, often we ask ourselves, how much does Friday matter? How much does what we saw on Wall Street on Friday really matter for European equity markets? Well, perhaps it does a little bit today, because we did see considerable selling into the afternoon over on the United States, on Wall Street, and so we could see some of that negativity influencing what happens here in Europe, especially as the rhetoric, the build-up in rhetoric between the US and Iran has also lent in a negative risk direction, and so both of those two factors conspiring together to suggest that we will go weaker at the start of the European trading day. Let's have a look at the European futures picture, which is considerably weaker this morning. So we are expecting to see some pretty heavy selling. Maybe the DAX gets the worst of that. You saw it briefly, then it disappeared. We are expecting, Lizzie, then that the markets across Europe will be negative overall. The DAX could get the worst of it. The FTSE could be a little cushioned by some of the basic resources.
Yes. In terms of some of the individual stocks that we're watching this morning, Anna, we start with a bit of M&A action. You've had Poste Italiane saying that it's going to launch a voluntary public offer valued at about 10.8 billion euros for Telecom Italia. So they're seeking full control of this former phone monopoly and setting up its delisting. Then we're watching the miners as well, because we've seen gold and silver tumbling on the inflation fears around the Middle East war. Copper also at its lowest in more than 3 months. And then Delivery Hero in focus as well. Gaining on TradeGate, it's agreed to sell its Food Panda operations in Taiwan to Grab Holdings, which is of course backed by Uber, that for about $600 million. So 3 to watch there for you, Anna.
Yeah, absolutely. So, Lizzie, we focus in on the negativity that we saw on Wall Street on Friday, the rhetoric over the weekend between Iran and the United States, all of it centred around the Straits of Hormuz, of course. We also focus on an Asian session that's been considerably in the red, down by more than 3% on Asian equities. But part of that was Friday's story. Part of that was the negativity that we saw on Wall Street in Europe during Friday's session. So what will we see here in Europe today? The Stoxx 600 does seem to be wanting to open in negative territory. I can't tell you a lot of detail about just how negative, but it does seem as if it wants to open in negative territory. The FTSE could be a little cushioned then, Lizzie, as we've been saying, because of the makeup, some of the oil majors in the mix there. Maybe we'll get more negativity coming through on the German market. There we go. But we've got the German market yet to open, as our graphics seem to want to have a life of their own this morning. Lizzie, what have you got for us?
Well, they're feeling very Monday. It's red across the screen for European equities. We've got the Stoxx 600 down 1.3%, the FTSE 100 down 1.5%, the CAC Cajon about the same. We're waiting, as you say, for the DAX in Frankfurt. But if we look at the individual sectors, again, everything in the red. Bottom of the basket, utilities, technology and industrial goods and services down as well, all by more than 2%. The best performer is construction, autos and parts as well, but still they're down by more than 0.6% this morning. Now, we can check in on some of those individual movers that we've been flagging. We said that the mining names were ones to watch, given, of course, the moves on copper, in gold and silver as well. And so we've got red across the screen yet again for those as well. So BHP, Anglo American, Glencore, Rio Tinto, all down this morning. BHP by 1.4%, but the rest down more than 2%.
Let's get a quick check on what's happening on gilt markets then, Lizzie, because we were primed for something fairly dramatic at the start of the trading week because of what had happened on Friday, because of the conversations all through the weekend and the narrative coming out of the Middle East. So the UK 2-year bond yield rising to its highest since February 2024. So that's the short end of the UK curve, where we see those gilt yields, yes, rising by 8 basis points. We see a rise at the 10-year horizon of 6 basis points. I mean, we saw substantial moves and bigger moves than this during Friday's session, but this is just another day of these yield moves to the upside.
And indeed, traders now fully pricing 4 quarter-point Bank of England hikes in 2026, not adding up with the message that we've been hearing from analysts that this just isn't possible to be hiking rates so much with such a weak growth backdrop in the UK.
Yes, and I think even the Bank of England governor suggesting that perhaps the market had got a little ahead of its skis, pricing in quite so many hikes when what we've got from them was a definite pause. Let us have a look at where we are on the broader market conversation this Monday, 23rd of March then. Let's bring in Maria Minucci, who is multi-asset fund manager at M&G Investments. Maria, good morning to you. Nice to have you with us. One of the questions I'm thinking about this morning is the extent to which you want to be invested, the extent you want to be in cash. I was listening to Warren Buffett talking just days ago, talking about how if this is prolonged, if you're talking about medium-term investments, maybe you want to stay in stocks, stay in the real economy, not in cash, but you maybe take a different view. What are you thinking about?
Well, our positioning going into this situation has been to have a relatively neutral exposure to equities, but with a very strong preference for markets outside the US. So within that neutrality in equities, actually having some very specific bets, for example, in Asian markets, which, even after the strong volatility we've seen in the past couple of weeks, they're still up considerably over the years. If you look at markets like Korea, for example, we have seen some very strong returns there at the end of 2025 and again into this year. What we've also entered this phase with is actually a relatively large amount of cash. And that has been very helpful in a situation in which actually we haven't had many assets diversifying out in this phase. And very interestingly, even assets that in 2025 had seen as a potential diversifier like gold has proven actually to be very unreliable in this phase. The dollar, I would say, has probably been the only area where we've seen a bit of diversification. Certainly not on government bonds, although it's still an area that we do like. And we think that maybe this reaction into this latest week has been a little bit overdone and might present some opportunities as well.
Okay, so interesting. So you keep some cash, and you say that means that when you see dislocation in these markets, you're able to reinvest. I mean, have we seen dislocation that encourages people into these markets, and if so, which assets?
Well, I think what we've seen so far is actually been a very measured response to a development of events that is pretty important for the global economy. Obviously, in different ways, depending on the different regions and how reliant they are on oil or on gas, but certainly a very, very important set of events from an economic standpoint. And the reaction so far, especially in equity, I would say has been relatively muted. Obviously, today we're seeing a little bit more volatility, but if you look at also the markets that have sold off the most, are actually those that have gained the most in the previous weeks and months. So there's been a sort of profit-taking more than complete risk-off on this market. So at the moment, we don't see opportunities to re-engage yet in the equity complex at large. Obviously, there might be some selected opportunities. For example, Indonesian equities have been particularly weak. So at the margin, I think a little bit of a diversification there. But all in all, I think the response has been very muted. Where it has been less muted has probably been on government bonds, where we have seen a reaction function that was very significant. Obviously, there is risks of inflation reaccelerating, and the energy drive. It's very important, both from a direct consequence, but also the indirect consequence towards inflation. But the move we've seen is very, very significant, and I think it might start providing at the edges some opportunities, especially because it feels like at the moment the market is pricing in this inflation risk, but is not really pricing in the growth risk that could come with it should this tension and conflict remain quite extended.
Well, we've got loads of PMIs coming out this week. Do investors treat it, if they're weak, as bad news for earnings or good news because it kind of takes off some of the pressure for central banks?
Well, it's a very good point, because at the moment, actually, we have seen this resurgence on interest rate expectation from a monetary policy front. So going from, a stable monetary policy into 2026 in places like Europe, or, reducing rates to increasing rates significantly for 2026. And normally you will expect, this type of shift to have an impact on equities as well. But we haven't actually seen a lot of it so far. So I think it will be interesting to see, how the market takes this. And it's going to have a balancing act, especially given where governments are today from a fiscal standpoint. If you go into the economy and correct significantly to respond to the inflation threats, then you're going to have to respond to support consumption in different ways. And not all governments are in the right shape to be able to do that like they have been doing in the past. So I think you will find a lot of tension between interest rates and fiscal expansion within government.
Especially in the UK. And we had gilt yields up last week. They're up again this morning. You're looking at the 10-year gilt yield up 5 basis points, the 2-year up 7 basis points at 4.6% this morning. And yet you see opportunities across the gilt curve. Where?
Yeah, I think, especially in the belly of the curve, we have seen such significant increase in yields that they make us think that potentially you have some opportunities. Again, the market is pricing in more of an inflationary risk than it is a growth risk for that market. And I would say gilts has been the epicenter of that volatility within bonds. But actually, if we look at other areas like BTPs in Italy, they've also seen quite a significant sell-off and move in yields. So there is potentially opportunities if we look in a longer term perspective. Obviously, we're very careful of not making any focus around how things will play out, but there are different scenarios, and then we're trying to understand what type of weight is the market giving to the different scenarios. And I think at the moment, the one that seems less likely from a market pricing standpoint is this deterioration in growth. And maybe because we have seen in the past that, if we look back at 2022, you had an inflation spike, but then growth actually remained pretty resilient. So despite the volatility you had in equities in 2022, you then have some very, very interesting returns in the asset class. So many investors might be less willing to step back, knowing that eventually you will get good returns.
So you think it's going to be different this time then? It's going to be, the growth impact will be bigger compared to what we saw in 22, because bond markets do seem to be reacting just to this inflation concern, don't they? Is it just a question of time then, Maria? We just, in the end, we are going to pivot from inflation concerns to growth concerns on bond markets?
Well, it depends on many different factors, so we're not positioning ourselves for that scenario alone, but we do consider that as a possible scenario, which I think is something that the market is less inclined to, and so that's where we find opportunities at the margin. But we also have to say that we started this phase from a relatively strong growth backdrop, especially if we look at the US and the fiscal stimulus ongoing there. Oil prices was particularly low. We had a phase of oversupply in oil, so I think that also made it so that it took a little bit of time for the oil price to respond in a more aggressive way to the events that then took place.
If we can just come back to stocks, you can see there the FTSE 100 into correction territory, that headline just crossing the screen there. But you mentioned that you're underweight the US, and actually you've got some saying that we're getting to the point where big tech becomes irresistible. You're questioning how insulated it actually is from geopolitics, but because the Mag 7 is putting up these superior earnings and continues to, park Nvidia for a second, you've got some saying now's the time to buy.
Well, I think it's been a super interesting behavior of this part of the market in the last few months, because if you look at US equities, they've actually gone sideways for many months now, and they've been more resilient so far in this phase of volatility. But even within the tech sector, you have some very different behaviors. If you think about software at the beginning of the year and how much weakness we've seen there, and then actually in this latest phase of volatility, it's been a lot more resilient. So we have seen some opportunities within this sector to be able to add on a stock-specific basis. But overall, I think, the AI story, although it's got a lot of capital and strength behind it, is not going to be completely insulated by these trends, because there are elements of supply chains that might be impacted. There are elements obviously linked to the energy complex that this sector is not completely insulated from.
Maria, can I ask you about corporate credit? We've seen spreads quite tight, of course. I wonder what you think about corporate credit right now, and if you don't like it, is it because of those spreads where they are now, or is it the risk around private credit and how we could see some contagion really from the private credit markets into public credit? What are you thinking there?
I would say the starting point is the credit spreads and the levels that we're seeing today. We don't feel that you're getting compensated enough for the type of risks that we're seeing, in the environment. And specifically, this has been exacerbated by what has been happening on the private credit side, and some of the early accidents that we've seen there. Obviously, it's not a complete given that you're going to have a spillover onto public credit markets, but it is the more liquid part, of that complex. And so if people have to de-risk, there is a possibility that will be the area that they will look at. I think an interesting way to play this is to be long the physical credits. We have a very strong team of fund managers that, can deliver alpha in this market still, but at the same time edge the overall credit spread, so edge the beta, and give us that possibility to then reopen the trade when we think there is opportunity, even in a market that is potentially less liquid.
Maria, thank you. Thank you for coming to see us. That's Maria Muniki, multi-asset fund manager at M&G Investments. Let's check in on the Core 6, shall we? It is, of course, red across the screen for the Stock 600, as it is for the Core 6 this morning. Particular losses for Rheinmetall out of Germany, also for Novo Nordisk. But as I say, every sector is in the red this morning on the Stocks 600. This risk-off mood as we have the tensions heating up in the Middle East. Let's get a check on some of the individual stocks that we're watching as well with Jennifer Creary.
Good morning, that's right. So we're seeing some of those, the impact of the fall in gold prices affecting some of those gold miners. We got Antofagasta and Fresnillo down more than 3% on the open. That's, of course, as investors sell off from war in the Middle East. And there's growing concern over the risk of inflation, but also higher interest rates. And we can see that bleeding into some of the mining stocks this morning. Next up, we've also got an eye on Telecom Italia. Telecom Italia rising on the open, up 4.7%. Poste Italiane down 5.6%. That's after Poste Italiane said that it will launch a voluntary initial public offer for Telecom Italia valued at 10.8 billion euros. Those shares diverging on the open off the back of that bit of M&A news. Next up, we're going to flip over to Xauusd. Xauusd falling 6.6%. That's after the company, which produces steel products like steel tubes, reported sales that missed analyst forecasts. It reported a full-year loss of 70 million euros. Investors clearly unhappy with that performance. Finally, we're ending on ING. ING, the Dutch financial institution, falling 2.7% on the open. That's after it was cut to equal weight by Morgan Stanley analysts. That's part of a broader Morgan Stanley note from analysts turning more defensive on European banks. ING, one of the losers this morning. Back to you.
Jennifer, thank you. Jennifer Carreri with an update on some of those individual movers. And there are some that are not responding to the broad risk-off theme that we see in markets. But overall, we see European equity markets then considerably weaker, down by 1.6% on the 1.5%, sorry, on the stock 600. The FTSE a little cushioned, the AX a little cushioned by what we're seeing broadly, Lizzie, across these markets, but not really. I mean, energy stocks not performing the role they did last week, which is interesting in itself. So last week we saw energy stocks doing pretty well when other stocks didn't. And today we see energy stocks down by more than 1%.
Yeah, they're the second best performing sector of a basket of every sector being in the red. Consumer products and services lead the gains. Energy in second place, but bottom of the basket, basic resources. We expected this, didn't we, given the moves that we've talked about in gold and silver to the downside. You are looking at gold weaker 5.4% now at $4,250 a troy ounce. And then when it takes you to the miners, Fresnillo down 3.7% as a result. Well, coming up, we have the IEA saying that more than 40 energy sites have been damaged by the Iran war. We'll discuss the implications for the sector next. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this field forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a
Big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. This is the opening trade. Another Monday of negativity across these equity markets. So we're down by 1.7% across European stocks, and all sectors are in negative territory. The worst performing is real estate, but down by 2.5%. The impact of higher interest rates in these markets perhaps having an impact there. Let's talk about what's been happening in the Italian communications space, because there we see some considerable movement in these stocks. This after Poste Italiane said it will launch a voluntary public offer valued at 10.8 billion euros for the former Italian phone monopoly, that is Telecom Italia, of course. Joining us now for more is Bloomberg's Daniele Lepido, who is in Milan for us. Daniele, good morning to you. So what does Poste Italiane's bid mean for the future control of Telecom Italia?
Good morning from Milan. Telecom Italia is still in the spotlight again and again. And yesterday it was an early spring, late Sunday evening when Poste Italiane surprisingly launched this bid. What it means that the state is coming back into the economy. It means that Telecom Italia, after about 3 decades from the privatization, is coming back to the state. And Meloni government, as we know, is tightening the grip on a pretty strategical services and infrastructure like Telecom Italia. We also need to remember that last year, Telecom Italia completed the sale of its most valuable assets, so the network, to KKR. So what the Prime Minister Meloni wants to do is creating a fully integrated digital hub inside Poste Italiane. Please remember that Poste Italiane is a huge conglomerate with many services. It also owns and also a so-called virtual mobility network, a virtual mobility of phone operator. So the meaning is creating a big digital platform to compete with other bigger rivals in Europe.
So, Daniele, why is the government backing this kind of consolidation now?
Yeah, that's a good question. I think that this move by Poste Italiane could kick off a wave of consolidation among carriers, phone carriers in Italy. As you know, Italian telecommunication market is one among world's most competitive with very low prices. And in 2018, French Iliad entered the market and lowered again the prices. So let's see what's going to happen. But I think that all analysts agree on the fact that Italy needs to have 3 carriers rather than 4.
Thank you very much. Thanks for joining us, Daniele. Good to have you on the programme. Bloomberg's Daniele Lepido joining us there from Milan. And we'll have more on this story as we bring you an exclusive conversation with the Telecom Italia CEO. That is coming up tomorrow, in fact, 9:30 a.m. London time.
Meanwhile, we have oil moving higher as investors assess President Trump's ultimatum to Iran to reopen the Strait of Hormuz and Tehran's threat of more reprisals. It's being described as the largest ever supply shock for global crude markets. And Will Kennedy, our EMEA news director, joins us now for more. Will, let's say that this deadline tonight, it's 15 minutes before midnight London time, comes and goes. what happens to oil prices then?
Well, oil prices are still grappling with the fundamental fact that the Strait of Hormuz is still largely closed and presumably will remain largely closed after that deadline. I don't think anything fundamentally changes for the oil market, apart from the fact that this conflict will continue to seem intractable. If Trump follows through on his threat, however, it will be an enormous escalation, especially given the threats that Iran has made to retaliate against assets across the Gulf, including energy assets, and it will make a resolution to this conflict seem further off. So in either scenario, unless Iran capitulates and says, yes, we're going to open the Straits, which I don't think anyone expects based on what we've seen from Tehran so far, it's a question of will oil go a little bit higher or a lot higher.
Yeah, okay, and it is going a little bit higher at the moment, isn't it? Well, I mean, given the equity markets seem to be responding as if we got a lot of new information over the weekend, and a lot of it was negative. US futures pointing down by, well, it was just shy of 1%, now a little better than that, but still pointing quite negative. Oil prices just making very modest moves to the upside. But interesting on the Brent curve, if you look further out the curve, actually we seem to be seeing more response and prices going higher further out the curve over the next year or couple of years. Does that give us a sense that maybe the market is increasingly thinking about the longer-term impact of this?
I think if we look at the market reaction across the board today, clearly it's about pricing in the fact that this conflict isn't going to stop anytime soon, and even if it does, there won't be a clear and quick resolution to the problems that we've seen build up through the global energy system over the last few weeks. I think many traders at the start of this conflict thought it would be short-lived, and you saw a lot of people trade oil on that basis. But as we get longer, the dislocations through the global energy system get worse, and the time it will take to get things back to normal increases, which is why we've seen the sort of pricing action further out that you described, Anna.
And indeed, in terms of that retaliation, you've had Iran just threatening to mine the Persian Gulf if its islands and coast are attacked. So it's only a heightening of the rhetoric on both sides coming now. Usually when it's Sarah Week, Will, we would be talking about that when it comes to the oil market. But of course, the focus is on the Middle East. Is there anything that we should be watching out for in particular there?
It's an interesting moment for the shale industry. Obviously, these prices are allowing the shale industry to sell forward a lot of its production at higher prices. So it probably means that those concerns about production in the US that we talked about from time to time, about shale slowing down, peaking, it probably suggests that it's giving the financial framework for the shale industry to continue drilling, to continue trying to exploit those resources as much as possible. So it's probably fairly bullish for the outlook. But of course, the other big question for the US is ratcheting higher of product prices. We talked a lot about diesel at $5. We've got gasoline at $4. And the economy in the US is very sensitive to these prices, especially when it comes to consumer sentiment.
Yeah, and interesting that we do see WTI moving as much, if not more, than Brent today, because last week we talked about a divergence.
The divergence was incredibly stark. We saw the spread between WTI futures in New York and Brent futures in London blow out to levels much higher than we normally expect, and there are reasons for that. Clearly the US is more self-sufficient. It's to do with the types of crude that are produced in both countries. But there was always going to be a bit of a catch-up, and the US administration has been really, really keen to keep a lid on WTI prices. There's only so much can be done.
Yeah, absolutely. And today we see them go over $100 a barrel, so 100 spot 29 is where we trade right now. Thanks very much, Will, for bringing us the analysis. Bloomberg's news director for Europe, Middle East and Asia, Will Kennedy. Coming up on the programme, we speak to Barclays chief US economist Mark Giannoni. We'll get his take on the Fed, the US economy in the context of war in the Middle East. That's next. This is Bloomberg.
you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question. I mean,
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Xauusd, and this is Next Africa. New episodes every month, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back, everybody. 30 minutes into Monday's session, and the European equity markets in the red, firmly in the red, down by 1.9% on the Stoxx Europe 600. The Xetra DAX getting the worst of the losses this morning of the major markets, down by more than 2%. The CAC 40, the FTSE 100, though, not far behind. And that's interesting that the FTSE 100 is selling off almost as much as some of the other markets here, because it had been cushioned by the resilience of the energy sector in recent trading days. Energy is kind of resilient today, but it's still in negative territory as a sector, as an equity market sector, and so that is something that is a little bit different from what we saw last week. Lizzie, what are you seeing under the hood in these markets?
Well, that negativity is pretty universal this morning. As you can see here, we have got volumes higher, but 579 members are in the negative territory today. Only 19 managing to eke out gains this morning, so reflecting what you've just shown us across the continent when it comes to the geographical breakdown. Let's have a look at the leaders and laggards this morning. Some of the leaders include Telecom Italia. We had that Posta Italiana offer earlier, so Telecom Italia up 5.4% at the moment. Is the reverse for Posta Italiana. BP, meanwhile, because we've got oil, we have got oil prices higher, but BP shares actually down 0.3% following the risk-off mood elsewhere, and Pandora shares up 4.3% this morning. We've seen precious metals moves, significant moves, and so Pandora up 4.3%. Let's take a look at the laggards as well. Siemens Energy is down 3.2% at the moment. ASML down 1.2%. You've seen that AI tech sell off, and then Rolls-Royce shares down nearly 5% because, of course, we have continued reduced air travel, Anna.
Let's talk about some of the individual stories that we're focused on this morning. And LaGuardia Airport is closed this morning after an Air Canada Express flight with 76 people aboard collided with a vehicle shortly after landing. Police say the aircraft hit a Port Authority of New York and New Jersey ground vehicle. NBC News is reporting that both the pilot and co-pilot died in the collision. German Conservatives, led by Chancellor Friedrich Merz, have dislodged the Social Democrats from power after 35 years in the southwestern German state. The win comes as Merz struggles to gain nationwide traction among voters. And meanwhile, in France, Marine Le Pen's national rally fell short in its bid to take control of a host of major French cities in Sunday's municipal elections. In Paris, socialist Emmanuel Grégoire was on course to win the race for mayor, extending the left's quarter-century hold on the French capital. And the US and Iran are trading threats as the conflict enters its fourth week, showing no signs of de-escalating. US President Donald Trump issued Iran a 2-day deadline on Saturday to reopen the Strait of Hormuz or face its power plants being bombed. While Iran's National Defense Council is reportedly saying that the entire Persian Gulf will be in a similar situation to the Strait of Hormuz if there's an attempt by US or Israel to attack Iranian islands or its coastline. Lizzie.
Well, the turmoil in the Middle East has sparked a rise in Treasury yields, with more traders pricing in a chance of a Fed rate hike by October, amid the concern that a protracted conflict could stoke inflation. Joining us now for more is Mark Giannoni, Chief US Economist at Barclays. Mark, good to have you with us in the studio.
Thanks for having me.
You don't think that's right. So I've talked about what traders see. They're pricing out Fed cuts this year. They're raising bets of a Fed hike by October to 50% as of Friday. But you see the Fed cutting in September and then again in March 2027. Why are they getting it so wrong?
Well, I mean, it's always difficult to say that the market is wrong, because obviously the market takes incorporates a lot of information. But we do think that the Fed is going to cut this year, in September most likely, and then again in March 2027. And the reason for that is that it's true, oil prices are pushing up headline inflation, but core inflation in the US is unlikely to move up a lot, at least if oil prices remain roughly where they are, and they are, according to the futures, also gradually declining after that. Headline inflation typically responds very quickly, but then we experience disinflation once oil prices have stabilized. And then core inflation, as I said, is unlikely to move very much in the near term. It's more gradual. And then there are also disinflationary pressures affecting core inflation at this point. Tariffs effect have largely passed through, and we think their effect are going to gradually come down from here. The housing inflation is gradually coming down as well, and services inflation is not growing fast. And in part, this is because wage growth has largely stabilized.
But at what point where does the oil have to get to for you to be more concerned about inflation?
Yeah, so we would need to see oil prices remain very elevated and potentially continue to rise, and in a very persistent fashion. And that's where we would see core inflation gradually move up and stay elevated for some time. And if this realizes, we are unlikely going to get the rate cuts. Actually, Chair Powell said as much last week. The FOMC also seems to expect a decline in rate this year as well as next year. But Chair Powell also said that this is conditioned on inflation gradually coming down.
So you still then expect that there will be a cut to Federal Reserve interest rates then, right. Mark, good morning. What about the rest? Where does that leave the rest of the world? Because are we going to be pricing something very different in Europe to the US, or will they converge to some degree?
Well, we think in that case they would converge most likely. So our European teams expects the ECB to raise rate later this year, and so that would lead to some slight convergence in rates. I mean, we're not talking about very large move both from the ECB or the Fed. I mean, if the Fed cuts, it's probably no more than one cut this year, unless the labor market suddenly deteriorates. And we've seen lots of fluctuations in the spread between the policy rates in the US.
And what do we need to know about the dual mandate of the Fed? And because that obviously sets it apart from some other central banks. When these mandates are in conflict, they need to prioritise the labour market. Is that the case? And to what degree do you think? When will that start to become a valid or an important factor?
You're absolutely right. So in the US, the dual mandate is absolutely critical. I think what the Fed does is looking at to what extent inflation deviates from their target and the labor market or the unemployment rate, let's say, deviates from what they assess to be the normal rate for the unemployment rate. And over what's the persistence of this deviation from that target? So if we did see a sudden increase in the unemployment rate, the Fed would very much focus on that, we think, on that part of the mandate, because they know that if the unemployment rate suddenly rises, it's going to take some time until the unemployment rate comes back closer to what they think is the longer run neutral. Whereas in this case, the inflation spike is more likely to be quite short-lived if it really turns out to be that oil prices stabilize.
And how long does the war have to go on for you to even start thinking about a recession in the US?
Yeah, so a recession, so we don't think a recession is very likely outcome at this point. It's definitely not in our baseline. A recession always is possible in any given year with maybe 15-20% probability. We think we would need to see further rise in oil prices, very persistently so that the consumer spending, which is already, we think, on a downward trend, suddenly falls more abruptly. Again, we think the fundamentals in the U.S. economy are still show a lot of resilience, so we think it's unlikely that we see a very abrupt decline in consumer spending. But if we did see that, we would likely see a pickup in the unemployment rate, and all sorts of other recessionary dynamics might kick in.
Okay, so that's the outside scenario.
Right.
Again, you are expecting the Fed to cut in September. How much does that come down to the change at the top? The idea that we might be getting Kevin Warsh. Will the Fed's reaction function change if he is the Fed chair?
Great question. I mean, we don't think that the change in the leadership of the Fed would dramatically change the policy reaction function, at least in the near term. The monetary policy is decided by the entire committee, so 12 policy members, and the other FOMC voters are pretty independent in their thinking, and they like to maintain that independence. So I think it's going to be very difficult for a new Fed chair to radically change the policy reaction function. And besides, I mean, assuming that Kevin Warsh gets confirmed in the next several months, we don't think he's particularly dovish either. Historically, he has been more on the hawkish side, so it's not clear that he would push for many more rate cuts than what the FOMC wants.
It was clear from the last Fed meeting then, Mark, that the Fed is watching for inflation to come down as a result of the tariff effects dropping out. Yep. What role is AI going to play in complicating that inflation dynamic in the US? Because we've seen, before we were talking about, always and everywhere about the Iran war, we were talking about AI all the time. And we were talking about a huge amount of CapEx and investment going into AI. And some have suggested that in the short term that might be inflationary. On the other hand, job losses. So what's your latest take on what this does to the short-term and medium-term outlook for the US economy?
Yes, very well. So I think in the short term, as you alluded to, I think it's more inflationary in the sense that it creates more of a drain on resources. There's more employment involved in building the whole infrastructure related to AI. Actually, we think it contributed a lot to spending last year in terms of equipment, computer-related equipment, data centers, software investment as well. So that involves a lot of activity, employment, and also slightly inflationary as it requires more resources to be built. Longer term, it may well be disinflationary in the sense that it improves productivity, and over time we may be able to produce more with fewer employees, and it may dislocate the labor market. But this is a much longer horizon, we think, than the near term that we are talking about. So when we talk about like 2026, 2027, we think we are not yet going to see all of these disruptions to the labor market or the disinflationary trend.
But how much do you think that AI boosting productivity growth will raise the neutral rate?
For policy rates. So we think there is a chance that over time, to the extent that growth rate of the economy is going to be boosted by AI, but this is, again, over longer term, that it would eventually lead to a higher neutral policy rate. But there are other factors going against that. So demographic factors are really important in the US, as the labor force is now pretty much flattening out as you see more and more people moving into retirement. We are seeing also other factors that are contributing to potentially the lower policy rate over time. But AI could be an offset to that. So we think, again, this is something that would happen a few years down the road, not in the near term.
Mark, what's the risk to the scenario that we've just discussed? What's the risk to the fact there's no recession, that you get one rate cut though coming through in the US? What's the biggest concern? Is it to do with the Middle East, or is it something more domestically generated?
I think in the near term is very much the Middle East. Nobody knows, I guess, what the outcome of this war is going to be, how long it's going to last, how elevated the oil price shocks could be, and for how long. So I think these are all huge question mark, and Chair Powell alluded to that during the last press conference. So we think if oil prices remain much more elevated than in our baseline, so more elevated now and don't experience this decline than that the futures seem to indicate, then I think we could see at the same time more inflation and more of a downturn.
Yes, yeah. Chair Powell was also very clear, saying they don't have a huge amount of conviction about their forecast for the rest of the year because of all of those uncertainties. Mark, thank you very much. Thanks for coming to see us. Mark Giannoni, the chief US economist at Barclays. Now, the chief executive of UBS says energy prices are likely to stay elevated as investors digest the impact of the war in Iran. Sergio Amolti spoke exclusively with Bloomberg at the China Development Forum in Beijing.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so. But in a sense, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, this pressure that I mentioned before on the economy will start to wade into the market.
The UBS CEO Sergio Amolti speaking exclusively there to Bloomberg's Stephen Engel. Well, coming up, we'll bring you more on the broad market sell-off as we dive deeper into today's moves and look ahead to this week's macro events. We are very negative here in Europe. The Stoxx 600 down 1.9%, but it is red across the screen for European equities as we see oil higher at 114 on Brent, up 1.7%, a risk-off mood around the world. Stay with us. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We are 49 minutes into a European session this Monday morning that looks really quite negative for European stocks, down by 1.6%. The FTSE 100 a little protected perhaps, the CAC 40 a little protected from what's going on, but not as much as it was last week in the case of the FTSE. The Xauusd DAX getting the worst of the selling, down by 1.8%. And if we look stateside, Lizzie, we see US futures are also weaker, suggesting that this has another day perhaps to go.
Yes, indeed. But let's get some analysis. Skylar Montgomery-Koenig from our Bloomberg Markets Live team joins us, as well as Rod Turnbull from Bloomberg Intelligence. Welcome to you both. Rod, I'm going to start with you talking about the equity picture. There's an interesting piece from our colleague Michael Masika on the terminal today, saying that, and this is according to a survey, market strategists are quite sanguine actually about the inflation fears because of the war, and they expect European stocks to return to record highs. There's a nice quote in here from Bank of America saying that the level of bullishness on European equities is diminished but not derailed. Does that tally with your view?
Well, it's interesting. It's always over a weekend. And, in terms of foreign policy from the US, this is probably the most sclerotic weekend we've had. So, of course, it had that sense of foreboding.
And I should point out that this survey was pre the ultimatum, but
right.
post the start of the war.
Yeah, so, it had a sense of foreboding over the weekend. And, of course, now we're coming back on a Monday with risk perceptions very high. Who has a crystal ball and can tell where this goes and where the timeline may end? But when we look at a number of barometers, which is what our equity strategy team's doing, Laurent Douillet in particular, we'll look at equity markets and we're getting back to support levels in the likes of the S&P 500 and the SXXP. The Nikkei seems to be heading that way. We've obviously seen bond spiking, bond yield spiking, the oil price spike. Five-year CDS has certainly moved as well, and it's getting a little bit more concerning. But I suppose when we look at this, in terms of fair value, and now all feeding into our fair value model, we're looking at a world where we were 16 times PE, say a couple of months ago prior to this conflict, and we're now looking at 14 times, which we think is about fair value.
So does that mean? But so things are cheaper in Europe. European stocks are a little cheaper, maybe around fair value. But are investors willing to step in right now with things looking, as to use your word, as sclerotic as they did over the weekend?
Oh, for sure. You think there's risk management been done and people will be looking at markets now in those key barometers, right? I mean, if we look at EPS growth, we were 11%, the market was discounting 11% EPS growth in Europe back end of last year. We were about 3 to 6%. So we do think there's some downside, but it's not quite Armageddon levels yet. And so, of course, next up will be the results season. won't be so much about the results themselves, but the look forward of the companies. And higher oil prices, higher inflation, lower growth, that's all going to play into this. So the question will be, is 14 times about right, or do we have a little bit of a downgrade from the market coming? And one would assume the latter is probably true. Yeah.
Skylar, let me bring you in here because we've seen some real outsized moves when it comes to precious metals. Gold's now down 5.7%, 4,235 is where we trade. Silver down more than 5% as well at $64 an ounce. Bringing it back to equities, though, how much are the losses that we've seen on the Kospi in Asia tied to what we've seen in precious metals on silver?
I think it's all around this environment that we had prior to the conflict, where you had so much money rushing into very small markets. So the Kospi is one of them, gold is one of them, silver is one of them. And because that, it means you have an environment that has higher volatility. And so that means that there's more room for de-risking. More money can certainly come out of those markets. We're only undoing the year-to-date gains in gold. We had many years of big gains before that. And it also means that you can't rely on your kind of historical relationship. So gold has been used as a safe haven previously, but because you've had a huge amount of money shift into that market, it means that you had structurally higher volatility in that market as you entered this year. And that's not something that you want in a safe haven. It needs to be a store of value. And so it just negates that property entirely. And then as we've seen year to date too, or at least on the conflict in Iran, it's not had a negative correlation with risk assets. So that's another kind of tick against it in the safe haven column.
Skylar, can I ask you about bond markets and where we maybe are nervous that governments, stretched governments where they exist, are going to be wanting to help out their populations with the higher energy costs, and where that's going to be difficult for bond markets to absorb. So we see bond yields going a little bit higher here in Europe once again. They certainly were a lot higher during Friday's session. I'm drawn to a couple of examples of this, and they're not all from Europe, but just this morning, Greece saying it's taking more measures to address the surge in energy prices. China, very different geography, different story, but of a similar theme, saying it may adopt fiscal and tax support if crude prices surge. This is going to be something that catches on. Where are you concerned that we don't have the ability to do this?
Yes, I mean, this is a big concern because we're coming from a period where you already had deficits increase quite substantially because there was support provided to higher energy prices in 2022, 2023. So there are a couple places that are kind of fiscally vulnerable, like France, like the UK, and we've had yields rise at the end of last week, partly on this acceptance, I think, greater acceptance that energy prices will stay elevated, but also because of the monetary response, where monetary policymakers have said that they're more prone to react to supply shocks post-2022 than they maybe have previously. And so we've gotten the monetary policy reaction, but we're still waiting on the fiscal. Now, Starmer is meeting today to talk about whether or not there'll be more spending in the UK. And this is a very vulnerable market, not only because post-2022 we had the Liz Truss crisis, so you get a more reaction from the market whenever there's something done poorly in the UK, but also because so much of the UK debt is inflation linked. So you get this really negative cycle when inflation rises, where it means that the Bank of England needs to hike because there is more of a response function within the UK to higher inflation. But you also have debt servicing costs rise automatically as a result of that, which means your fiscal position gets worse from the debt servicing side, but also growth being lower means you have fewer tax receipts. So the UK has seen underperformance, and I would expect that underperformance to continue.
So, Rod, let's say that fiscal support is not forthcoming, but the hikes from the Bank of England are. Where does that leave domestically focused UK stocks?
Well, I suppose in that position of people will be looking at defensive type plays, I guess, for the time being, and rightly so. I mean, the escalatory pathways to this conflict look pretty bleak. And fraught with risk. So when we think about sectors that we're quite interested in, defense is obviously going to be one that people will probably keep exposure to. One could debate what's currently discounted in the valuation of some of these stocks, but regardless, you can see people will likely pull the defensive lever and stick with something like that. The other area that I'd mention, though, as well is pharmaceuticals. One of the things that we do in BI is an enormous amount of patent risk work. And we've looked at 4 of the world's biggest drugs from 4 of the world's biggest pharma companies. And the assumption that we're making is they're protected much longer than the market currently assumes, therefore higher revenue. So plays like that should be of interest.
Really interesting. Thank you for that. That's Rod Turnbull from Bloomberg Intelligence and Skylar Montgomery-Koenig from Bloomberg Markets Live. Thank you both. Well, plenty more coming up on Bloomberg TV today.
Absolutely. We are going to be hearing from Fed Governor Stephen Miron, 12:30 London time, the sole dissenter at the last Fed decision. So not a surprise, perhaps, that he dissented, but interesting to bear that in mind as we hear from him. European equity markets then very much on the back foot this morning. We'll leave you with the team on the pulse. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersetchi in Davos, Switzerland, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini.
We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The global sell-off deepens. Stocks, bonds, and gold all falling as the U.S. and Iran step up their rhetoric. President Trump threatens to attack Iran's power plants unless the Strait of Hormuz is reopened by tonight. Iran doubles down with fresh strikes across the Persian Gulf. Plus, Italy's Poste makes a €10 billion bid to delist Telecom Italia, turning from its biggest shareholder into its owner. Now, this is a picture across the board for what we're seeing in asset classes. Again, fears of this possible escalation in the war in the Middle East is driving sharp declines in stocks and bonds after the U.S. and Iran toughened their rhetoric. U.S. crude hitting $100 a barrel, gold falling to its lowest level this year, global yields surging as concerns that higher oil prices would stoke inflation definitely intensify. That means the UK 10-year yield has moved quite significantly at 4.673 and Brent 113.37. Now, the picture for the European map is actually quite significant in following some of the declines that we've seen overnight also in Asia. And you can see there's just a lot of red on your screen. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. and Iran continue to trade threats with the conflict now in its fourth week. Under pressure to bring down surging oil prices, President Trump issued Iran with a two-day ultimatum to reopen the Strait of Hormuz, which ends at 7:45 p.m. New York time today. So let's get more from Bloomberg's Abir Abu Omar. Hi, Abir.
Good morning, Francine. So the clock is now actually ticking down on President Trump's 48-hour deadline for Iran to reopen the Strait of Hormuz or have its power plants bombed. Iran has countered that if its power facilities are attacked or if it would close the Strait of Hormuz completely. Now, in a Truth Social post, President Trump said that Iran must, quote, fully open without threat the waterway. Meanwhile, Treasury Secretary Scott Bessent said U.S.-Israeli attacks on Iran are aimed at destroying its fortifications along the Strait of Hormuz. Now, the strait, of course, which carries a fifth of the world's oil and LNG supplies normally, has been effectively shut, as we've been saying, since the U.S. and Israel began attacking Iran late February. Now, this has pushed Brent prices up by more than 50% since then. Iran's strikes in the region have been continuing across the Arab Gulf, but also in Israel. The U.S. has also ramped up pressure and deployed additional troops and suggested that it may strike the oil-exporting Kharg Island. The Iranian military also said that it will target energy, IT, and desalination infrastructure that is linked to U.S. and Israel across the wider region, with a senior Iranian official adding that the headquarters and assets of financial entities that buy U.S. Treasury bonds are, quote, legitimate targets. The escalation in this rhetoric, Francine, by both the U.S. and Iran has driven a global market sell-off. We've seen this morning with Europe's stock 600 set to enter into correction territory, and gold that is now slipping to around $4,200 an ounce. Francine, back to you.
Okay, Abir, thanks so much. Bloomberg's Abir Amar there with the very latest on what happened at the weekend. Markets definitely risk off today as a sell-off in stocks, gold and bonds deepen. Let's discuss all of this with Seema Shah, Chief Global Strategist at Principal Asset Management, and Paul Wallace, our Middle East and Africa Managing Editor. So thank you both for joining us. Seema, first of all, I mean, the market is oscillating between risk-off, panic, and actually things will be okay. Where are we today?
Well, look, I think once the European close happened on Friday, I think there's hopes that we could have hit the peak worst point, and that over the weekend there may be better news, the markets would have seen some light, and then today would be a better story. Unfortunately, I'm sure anyone looking at the market this morning will have been quite dismayed to see that even after such a significant sell-off on Friday, we've seen that continuing into Monday. Now, it's not as severe as what it was on Friday, at least so far. But the fact that it's continuing just tells you that the market is very concerned about when is this going to end, how far oil price is going to move, and what's next. I think that's really the key question.
I mean, how do markets find a floor?
So I think we have to get to the peak point where markets fully confronted what the risks are, fully confronting the idea that this is going to be a very prolonged conflict, very likely, and even in terms of once the strait is open, the fact that actually oil and energy, other commodities which are reliant on that, is going to take several months to get back to normal. So I think we did see some last week with central bank expectations moving to hikes, but there's probably a bit more to go.
I mean, Paul, this, I guess, is a concern, is that there was an understanding in the markets that there could be some kind of off-ramp. And when you hear Donald Trump, one time out of two, he says, look, we're nearly the end of the conflict, but it's unclear how this gets de-escalated.
Exactly, and the other time out of two, he's talking about hitting Iran harder or whatever the case is, and that's the situation where we're in right now. On Saturday night, Trump gave Iran a 48-hour deadline to reopen the Strait of Hormuz on his terms completely, as he put it, or face the obliteration of its power plants. If Trump follows through with that threat, that is a major escalation. Iranian officials have come out and pretty much all said that if the U.S. does that, then water and power infrastructure in Israel and in Arab Gulf states are going to be targeted. And we know that Iran can cause significant damage. We've seen this already with strikes on the likes of Ras Laffan, the LNG terminal or production site in Qatar, and energy sites across the region. So it's a real threat, and that would mark escalation if Trump decides to go through with that, because in all honesty, Iran is not going to reopen Hormuz by tonight as Trump wants it.
I mean, what does Iran want right
This
now?
is a good thing. We've reported that one of the things it wants is some kind of guarantee or pledge from the U.S. and Israel that they won't attack the country again in the event of a ceasefire or this current war ending. It also wants reparations. I mean, these things are pretty much non-starters as far as the U.S. and Israel are concerned. It's going to be, they're not going to give reparations to Iran. They may be able to unfreeze some assets and allow Iran to classify that as reparations. But it's very difficult to see Trump and or Benjamin Netanyahu saying to Iran, we are not going to attack you in the future or give any kind of pledge that strikes in the future on Iran are off the table.
Seema, I mean, we also heard from the IEA that more than 40 energy assets across the Middle East have been damaged since the conflict. I mean, is there, again, can oil go to 200? It's unclear at the moment. There's a lot of stockpiles that are being released, but then we don't fully understand the scale of the damage that's been done to a lot of this infrastructure.
Right, and I remember, just a few days after the conflict started, we did see a couple of estimates suggesting that $150 to $200 a barrel would be possible if you get a multi-quarter stoppage of the Strait. Certainly that is, we are moving close to that point, but again, at the same time, Brent has, it hasn't had a very significant move up in the last few days. It's been fairly stable in the 110 to 115 or so range. But I think it's really about the vulnerability beyond just what happens to oil. I think that's the next stage is, thinking about fertilizer, thinking about sulfur. What is the impact which goes beyond just the standard energy and oil price effects that we can see?
Paul, I mean, if you're the U.S. right now, what do you need? I mean, you're going to the midterm in 6 months, so you definitely don't need oil at 110, certainly not at 200. So is there not an incentive to really de-escalate and definitely go for a ceasefire?
There certainly is that incentive, and you talk about oil prices. I think even more so for Trump, he'll be looking at gasoline pump prices in the U.S., and we're close to $4 a gallon as a U.S. average. That's a bit of a psychological marker and something that Donald Trump certainly won't want. We're seeing fertilizer prices go up, and we're seeing farmers in places like Iowa complaining about that. So it is a really big problem for Donald Trump. So he has that incentive to de-escalate. The problem is he needs to claim victory, and I think if he stopped right now, that would be difficult. Or a lot of people, his critics in the U.S. especially, would turn around and say, what was the point of this war? We aren't. Yes, you've degraded Iran's ability to produce ballistic missiles, and you've pretty much destroyed its navy and large parts of its military, but, is this really a victory? So I think he needs to get to that point where he's satisfied that he really can make this look like a win. And obviously he has to reopen Hormuz and make sure that the strait is fully opened to commercial vessels.
I mean, it's also a game of numbers, I guess, because the anti-ballistic missiles cost so much more money than the drones. Do we know or understand the capabilities, and how are the Gulf states reacting to all of this?
Yeah, that's certainly the case. There are huge asymmetries in warfare like this, where the interceptor missiles you're using cost multiples of what the offensive projectiles cost. Iran's ballistic missile firings, let's say, on the Gulf and on Israel have dropped overall since the first few days of the war, although those are still happening, and we've seen ballistic missile attacks, bad ones that injured more than 100 people in Israel over the weekend. But it's these Shahed drones, which give or take cost $20,000, that are a big problem at the moment. Iran is probably still able to produce those even during warfare because they're pretty rudimentary. They're difficult to detect. They don't cause as much damage as ballistic missiles, luckily, but they are able to cause fatalities and quite a bit of damage. That's a big worry for the Arab Gulf states and Israel.
And see, I mean, this has led to a massive repricing of what central banks will do, right? So there's almost no cuts on the table at the moment for either central bank. But this seems that the Bank of England and UK gilts are taking the brunt of this because of the inflation situation.
Yeah, exactly. I mean, if we're looking across the central banks, we have to think about what are their mandates, and I think that gives us a good idea of which one's most likely to shift. And then, of course, what is their starting point in terms of inflation for the US being above target for 5 years, but also for we know that the Bank of England has been very concerned about inflation stickiness. Now, the big turnaround, of course, is that whereas for the Fed, cuts were expected, most people are expecting just a pause for this year. For the bank, we've shifted from cuts right over to hikes. Of course, that's going to see the brunt. And that's really been at the front end. The next stage is obviously to see what happens at their 10-year point and beyond, if there's going to be any moves on the fiscal side. So there are still, I think, some stages to go through before the market can really say we have fully absorbed what the shock is and we're being a little bit more realistic about what's to come.
I mean, is it almost impossible at this point for them to look through this? Again, it's a supply shock, so it's not evident, how they deal with this.
This is the worst nightmare for central banks in terms of that dilemma. Certainly from our perspective, what we think is going to happen is that there's likely to be hikes across the ECB and the Bank of England. And then you get into 2027, well, that demand destruction really starts to play out. And then we could see some cuts coming through. But certainly for 2026, this looks like a really challenging year and a big turnaround from what investors were expecting this year to be. So that I think is a big hit.
Seema, I mean, do you have any concerns also about the consumer? I mean, the U.S. consumer, which we talk about on a daily basis, is really propping up this economy. I mean, with the headlines, with inflation, with gasoline prices, is there a worry that they really take a turn for the worse?
Well, so consumer spending was expected to be a very important part of the growth story for the U.S. this year, and that was going to be helped along by the OBBA fiscal stimulus. Now, with oil prices, gas prices where they are, you do get to a point that it almost cancels out the benefit from the OBBA. But overall, we're comparing the US over to Europe. It's a little bit different because we have got that fiscal stimulus in play in the US. But it's worth remembering that in 2008, it's when gasoline prices hit about $4 a barrel. That's what really accelerated recession fears. So certainly there's many numbers that we need to keep an eye on.
Paul, when you look at some of the mediators, so again, European nations have been very reluctant to enter this conflict. I don't know whether they'll have to be drawn in, significantly at some point. But do we know if China's getting involved, or at least trying to mediate things and take the temperature down?
To some extent, a lot of countries are trying to mediate, but it seems like it's at a low level at the moment, and it's not getting very far. Certainly, China's been talking to Iranian officials. European countries have been talking to Iranian officials too, and the likes of Turkey have, and Gulf Arab states. Oman has. We've reported that Saudi Arabia has. It's not making much headway, though, and all sides, let's say all three sides, Israel, the US, and Iran, are sounding very belligerent still. And for all Trump's, as you said, 1 in every 2 times talking of de-escalation, on the whole, it's still very much that this war will continue. That's the message from all sides. There's no backing down from Iran, and there's very little backing down or sense of backing down from the US and Israel at the moment. So all the warring sides seem to think that they can and should continue going for a while, for at least a while longer.
I mean, could it be months, or could it be even longer than that?
This is a big, big question. I mean, for Iran, this is an existential question. They see this war as something that is trying, an attempt by the US and Israel to topple the Islamic Republic. So I suppose you could say that time is on Iran's hands. You could almost say it's a bit like Ukraine when they're facing the invasion from Russia. It's existential. So they will keep going indefinitely. Trump is a big question. This market's chaos is something that, as we've mentioned, hurts him a lot. It hurts him far more than it hurts Netanyahu back in Israel. So Trump could be the key to this. It's, in some senses, it could be the point at which the pain becomes too much for him and his administration, and he says, "Okay, we've got to end this thing and take the off ramp."
Seema, what's the likelihood? Because we talk also a lot about the Asian economies really suffering with this price of oil. What's the likelihood that we could see a global recession because of this?
Well, so when we had been putting together scenarios, our worst case scenarios, you get that multi-quarter stoppage in the Strait. You see oil prices above the $125 a barrel to the top point. We don't really know where it can go to, and that's when you start to think about global recession. Now, through this, the US is still the most contained, the least vulnerable, and Asia is looking like the most vulnerable, China being the exception. So there are just, I think from a global picture, the Asia story is probably key to deciding whether or not we are approaching a global, very negative situation or not.
Okay, thank you both for joining us. A terrific way to get us started this Monday morning. Seema Shah, Chief Global Strategist at Principal Asset Management, and Paul Wallace, our Middle East and Africa Managing Editor. Coming up, we'll talk to the President of the European Bank for Reconstruction and Development about the impact of the Iranian conflicts. That's coming up next, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
The chief executive of UBS says energy prices are likely to stay elevated as investors digest the impact of the war in Iran. Well, Sergio Armotti was speaking exclusively with Bloomberg at the China Development Forum in Beijing.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But, when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain, and in that sense, the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, this pressure that I mentioned before on the economy will start to wade into the market.
Well, that was the UBS CEO, Sergio Armotti, speaking exclusively with Bloomberg's Stephen Engel. Now, surging energy prices from the Middle East conflict, of course, are threatening to cripple developing economies. In response, the European Bank for Reconstruction and Development says it's in talks with nations across the region and Africa to provide additional support as trade and remittance flows face major disruptions. Well, I'm delighted to be joined now by Odile Renaud-Bassot, the president of the EBRD. Thank you so much for joining us, as always.
Thank you.
I mean, when you look at what's happening in the Middle East, how are you monitoring developments, and what kind of impact do you think it will have on countries where you operate?
So, of course, we are monitoring very closely the development. There is a high level of uncertainty, so we need to work on the basis of scenarios and so forth. But we already see quite a significant impact on some countries. And of course, I mean, the impact is quite different from countries in the very close neighborhood. And I'm thinking, for example, particularly in Lebanon, which is the country now really in the middle of the war, with a huge displacement of population, a huge economic shock. So really a very difficult situation. Countries very close by, I mean, in like Jordan, Egypt, West Bank, for example, are also very directly, impacted by the cost of energy, but also the possible impact on tourism, remittances. These are countries which are very highly dependent on Gulf remittances from the Gulf, and so they may be directly impacted by this channel of contagion. But of course, more broadly, all countries dependent on oil and gas will suffer from the impact of the increase of prices. Our assessment is that if oil prices remain above or at $100 barrel for a long period, extended period of time, this has an impact on inflation of plus 1% and a reduction of growth of minus 0.4%. And this is what we expect on average on our countries of operation.
Odile, I mean, how do you see, again, what's the way forward for Lebanon? I mean, it's heartbreaking, really, what's happening with the displacement of the population. This is, again, a country that was really slammed economically for things that have happened in the past. How do you see that, can we talk about reconstruction yet?
It's very early. I think what we are trying to do is to continue to support private sector businesses which have, because people need to, for example, we still have some projects on the country for small businesses, private sector and so forth, but it's very challenging. And of course, this needs a political situation and a political solution with, because it's, part of the country now is really under heavy bombing pressure, military pressure and so forth. So it's really challenging and there is a huge need for humanitarian support.
So what kind of support or actually, discussions are you having with your partners on the ground?
So what we are thinking about how we can support our clients in the most affected countries, providing emergency support, liquidity support, working capital, sometimes where our clients need some restructuring, this could be considered also. So really working on a toolbox that can help addressing the situation from private sector businesses and possibly also state-owned enterprise in the countries affected. And it's, country directly impacted, but also a country like Moldova, for example, which is far away from the conflict, but it's very dependent on oil and gas from outside, will be impacted by the increase of prices.
So what have you learned? I know you've been very involved also in the war in Ukraine. What have you learned from, I guess, COVID and the war in Ukraine that could help some of your clients, if not weather the storm, better prepared? Because we also have, there's a huge amount of debt. And so a lot of the governments across the board just don't have the money to maybe be able to support the population like they have in the past.
Yes, exactly. So I think what is important is to react quickly, to use, a multilateral development bank like us can play a counter-cyclical role. So we are there for the long term. We are not going to withdraw and we are going to continue to provide support. And for government, when you're talking about how to support and to weather the impact of this energy price shock, you need to have very targeted measures because a lot of governments do not have a lot of margin of maneuver, and you need to find and to reflect about targeted measures so as to limit the impact as much as possible, the impact of the shock.
Odile, if energy prices, persist at these levels or go even higher, is there a figure or a timeline where we should really do the alarm bells? Like if the price of oil goes to 150 or 160, or the price of fuel and gasoline?
That would have a huge, that would be, I think, beyond the alarm bells. As I was saying, with the price staying at $100 a barrel, the impact on the growth is quite significant. Yeah. So if it goes much beyond, this would have, and the issue is an issue of price, but also a shortage of energy. So you see a situation in Asia where already there is some restriction on the use of oil and gas in order to limit shortages, the risk of shortages.
And we're also talking about fertilizer. There are second-round effects that maybe we'll find out in the next couple of weeks and months of how deep the crisis could be.
Yes, the impact on fertilizers is already quite significant because 35% of fertilizer, product for fertilizers production were coming through the Strait of Hormuz, and this has a huge impact. And countries like Kenya, for example, depend 30% of their fertilizers coming from, Gulf production. So the impact can go quite quickly, having in mind also that we are in spring. It's a season for agriculture where you need fertilizers, so this may have an impact also, accentuated by this fact.
Odile Renaud-Basso, thank you so much for joining us. That is, of course, the president of the European Bank for Reconstruction and Development. Coming up, Iran doubles down in the face of threats from President Trump, so we'll discuss how the Iranian people are reacting as well. That's next, and this is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. The global sell-off deepens. Stocks, bonds, and gold all falling as the U.S. and Iran step up their rhetoric. President Trump threatens to attack Iran's power plants unless the Strait of Hormuz is reopened by tonight. Iran doubles down with fresh strikes across the Persian Gulf. Plus, Italy's Poste makes a €10 billion bid to delist Telecom Italia, turning from its biggest shareholder into its owner. So the U.S. and Iran are trading threats as the conflict enters its fourth week, showing no signs of de-escalating. Now, the U.S. Treasury Secretary told NBC that the U.S. is trying to destroy Iran's fortifications along the Strait of Hormuz.
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate, Chris.
Well, with us now is Roxanne Farmarfarmayan, a lecturer at the University of Cambridge. Thank you so much for joining us. Professor, so first of all, I mean, where are we in this war? It seems that, I don't know whether, the U.S. thought this was going to end much quicker, and to me it's unclear what the U.S. are trying to do now.
Well, I think there are several problems with bringing this war to an end. One is, I think it's very clear that Israel and the U.S. have different goals, and that is one of the issues I think we're seeing over and over again. The U.S. is looking for an off-ramp They're anxious to declare victory, I think, and de-escalate. And that is not what Israel wants. Israel wants to destroy as much as possible in Iran and reduce its power so that it's no longer a threat to the plans of Prime Minister Netanyahu.
But Professor, I mean, listening to Donald Trump speak, it seems that, I don't know whether he changes his mind, but it's 1 hour we want to de-escalate, and 2, you will incur the wrath of the U.S. if this continues. So is there a real de-escalation progress, or at least, diplomatic talks to try and bring it down?
Well, I think it's one of those situations which we've seen over and over again. The United States goes into the Middle East and then it can't seem to find a way to withdraw. And it's something that makes certainly President Trump extremely angry that he cannot seem to locate that sweet spot in order to leave. So no, there are no negotiations going on. And as far as I understand, there are demands that are being put forth by Iran at this point, saying various things, that war has to be off the table, that all of the American bases have to be withdrawn. There are very specific elements that are saying no ceasefire. The end of the war is what we're asking for, and I don't see that happening very quickly.
How likely is it that we see regime change in Iran?
I think very unlikely, at least for the moment. The government is very, very strong. It is multi-layered, and it has made contingency plans so that if its top people get taken away, it has others in line to take their places. And I think we can say that regime change would be possible if the pressure on the outside reduced and the Iranian people themselves could get an economic situation that they could start flourishing in, and that would lead to them then saying, we really don't like this government very much, we're going to change it. But as long as there are enormous sanctions on the country, which pressures every level of the population, there simply isn't going to be regime change.
Yeah, I mean, there's also, a huge problem with who has the weapons, because we saw big protests and uprising at the beginning of the year, and they were quashed without impunity from the government.
Yes, I think that is, this is a brutal regime. I mean, it is certainly willing to impose enormous cost on the population. And we've seen this not just in this most recent protest. The Green Movement was an extremely good example of that back in 2008. So I think that part is definitely in the hands of the government. On the other hand, I think certainly it has weakened in this process, and I think the feeling of the population itself is more and more that they've got to rid themselves of this economic malaise, more than even the structure of the government. I think their view is more, we do not want to have civil war, we do not want to have chaos, we want to improve our economic situation, and that will lead to political improvements.
But Professor, I mean, if this is a fight for survival for the Iranian regime, how are the Gulf states also thinking of this? They have their economies squashed so far because of the drones. Can they live with a kind of, diplomatic agreement?
Well, this next part of, we're all waiting for what happens this evening. And if Trump does go ahead and attack the electrical grid in Iran, it has said it will attack the electrical and water desalinization grid in the Gulf. That would be a whole game changer. These are deserts. They're places that people completely depend on electricity and water that is not there. So that would actually change the whole profile of the Gulf. I think they're very worried about that. I imagine the pressure they're putting on Washington at this point is high. But I think it's one of those things that he feels, I think, that he cannot let Iran have an upper hand in this. And so we see this tit for tat, and it goes on.
I mean, Oman played a very important role,
and
now a little bit less because they didn't really get anywhere. Could China play a bigger role to mediate, or at least, again, just try and take the temperature down?
Well, I think that's a really good point, and also Russia. I think both of them are gaining quite a bit from this war, particularly Russia, as it's able to amass enormous amounts of income with its oil now off the sanctions list. And I think both have weight they can push with Trump and are considered honest brokers with Iran. So I would say this is going to have to become a much different kind of negotiation and moderation, if you will.
Why do you think the U.S. entered this war?
I don't know. In many ways, I don't even think of it as America's war. I think of it as Israel's war. And I think that the deal that was on the table during the negotiations, this last negotiations in Geneva, was actually a fantastic deal, better than Obama had received with the nuclear deal of 2015, the JCPOA, and really would have possibly delivered Trump the prize he's always wanted, the Nobel. But I think there was an element of wanting to work with Netanyahu on this, and Netanyahu has been pushing this war. And so I think, unfortunately, there was I would describe it as a real misstep going in.
I mean, there is, some people, there's a line of thought that's saying, look, with gasoline prices hit $5, that's when the U.S. says, look, we've done our job, let's get out. I mean, is that a possibility, and would that really make a difference?
I think not only the gasoline price, I think the drop in the stock market. I think we're seeing gilts going through the roof. I mean, I think there's several elements that really are close to Trump's heart and that he watches very carefully. And one of those is going to, I think, finally tip the balance. He cannot possibly imagine resuscitating his party for the midterms if the economic situation is like this. And it's going to have knock-on effects with the food and fertilizer, as you were speaking about.
Thank you so much for joining us.
My pleasure.
Faramaryan, the lecturer at University of Cambridge. Now, the head of the International Energy Agency has also described the energy market disruption as equivalent to two major oil crises of the 1970s and 2022 gas crisis all put together. Joining us now is Will Kennedy, Bloomberg's EMEA news director. So, Will, thank you for joining us. What happens now in the oil market?
Well, a lot will depend on what happens when this self-imposed deadline from President Trump passes at the end of our day today. I think it's fair to say that the eyes of oil traders will be firmly on what happens next. And I'm not sure there's a good oil market scenario in either case. If Trump decides to follow through on his threat and strike at energy targets inside Iran, we've heard from your previous guests that Iran is likely to retaliate against energy infrastructure across the Gulf. It's done that already, but it's threatened to step up those attacks, and that will be very bullish for the oil price. Even if he doesn't, there's no indication that Iran is going to concede to his demands and open up the Strait of Hormuz. And as we've discussed several times, Francine, the longer the strait stays closed, the more bullish it is for oil, the more stress we put on the energy system globally, and the more we'll see energy prices, not just in oil, but in oil products, continue to rise.
Well, how high could oil go as the disruption looks set to continue?
Well, I'm not going to give you a forecast, but we've seen some pretty hair-raising figures out there. I think that there was a story that said that Saudi Aramco, the big Saudi Arabian oil monopoly, had done its analysis and said that it was worried that oil could go as high as $180 a barrel. We've definitely seen those sort of figures in the 150 to 200 range bandied about, and while those are extreme figures, higher than crude has ever been, I think a lot of people in the market would say that if this continues for any length of time and strikes on energy infrastructure continue, that's inside the realms of possibility.
Will, what about gas?
Well, obviously, this is the other big story from the war so far. Last week, we saw the world's biggest LNG plant in Qatar hit by missiles from Iran. There was a pledge to step back from those kind of attacks, but that seems to be back on the table after the president's statement over the weekend. If we see any more attacks on Ras Laffan, on other gas infrastructure in the region, we could continue to see those prices go higher. And the important thing there is the length of time it takes to rebuild that gas infrastructure means the impacts will last months, years, and there's no quick unwind for this situation.
Well, thanks so much, Will Kennedy, there, Bloomberg's EMEA News Director. Now, Italy's Poste has said, of course, it will launch something. Well, Italy's, let me get this right, because it's one of the biggest stories that we're doing today. Poste is bidding 10.8 billion euros for full control of Telecom Italia. We'll have a full roundup of that. Of course, the move would fold Telecom Italia's operation into a Poste's retail network, creating possibly this combined entity with about 26.9 billion euros in annual revenue. So we'll have plenty more of that after the break. Also coming up, New York's LaGuardia Airport has closed to incoming flights after a fatal crash on the runway. We'll also have details on that next. And this is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Italy's Poste has said it will launch a voluntary public offer worth 10.8 billion euros for the former Italian phone monopoly Telecom Italia. Well, joining us for more on this is Daniele Lepido, Bloomberg's senior reporter. Daniele, thank you for joining us. So what does Poste Italiana's bid mean for the future control of Telecom Italia?
Yeah, good morning from Milan. Yeah, it's another day with Telecom Italia, and this saga is never over. Yes, basically it's a kind of full back to the state control of one of Italy's largest company, and the Meloni government is tightening its grip on Telecom Italia. I would like to remember that the Poste was already the company's largest shareholder, and now with this takeover means that Telecom Italia will become the digital pillar of Poste Italiane, which is one of the country's largest conglomerate.
So why is the government backing this kind of consolidation now?
Yeah, basically they need to have a big platform, a big digital platform to compete with other European and US players, and especially with the merging of nationalism, having, Telecom Italia fully integrated in Poste Italiane could be a big, something pretty important, very important for the company, or in order also to offer more services for EI, for example, and other digital services for enterprises, not just for consumer. Don't think just about consumers and customers, but also for enterprises and data centers, for example.
But Daniele, what changes for consumers and competition in Italy's telecom market?
Yeah, let me say that this move by Poste Italiane could in some way kick off a new wave of mergers because you know that Italy's telecommunication industry is one of the world's most competitive, and so that means that and other mergers could happen. We have 4 carriers in Italy, 4 big carriers, and the aim of the industry is having just 3.
Daniele, thank you so much. Bloomberg's Daniele Lepido. Now, German conservatives, led by the Chancellor, Friedrich Merz, have secured an election win in a socialist haven as he struggles to gain traction amongst voters nationwide. Meanwhile, in France, the far right fell short of taking control of some major cities during yesterday's municipal election. So let's bring in Oliver Crook, Bloomberg's chief Europe correspondent, to take us through some of the results. Ollie, good morning. So first in Germany, the victory seemed to soften the blow for the CDU after a stinging defeat in a neighboring state.
Yeah, I think that rather than sort of saying this is a massive victory for Friedrich Merz, the way you've put it is quite accurate. It softened the blow of some of the defeats that he has suffered since he became chancellor about 10 months ago. And we should say this is a candidate, this is a chancellor that is very unpopular, relatively speaking, in Germany. He didn't even get all the votes of his lawmakers in his own coalition on his first day when he was supposed to be appointed chancellor. And that has sort of been the kind of flavor going throughout his premiership. So 2 weeks ago in Baden-Württemberg, that was a much more significant election because it's a much bigger territory. The CDU managed to lose by a couple of points to the Greens, but now we see a little bit of redemption here for Friedrich Merz in Rhineland-Pfalz, where he managed to edge out the Social Democrats that held the seat for 35 years. We should also say, because we watch this with very close interest, Francine, in every state election, the AfD did manage about 20% of the vote, which is notable despite the fact that they came in third, because this is not really, generally speaking, a haven for them that is a stronghold for the AfD. So again, significant in sort of appraising the state elections. There are 5 of these this year in Germany, and really the ones we're going to be focusing on is a little bit later in the year, Francine, particularly in Sachsen-Anhalt, when we'll expect an election there where the AfD may not only win, but may get an outright majority, and that would be yet another blow to the Chancellor of Germany.
Ollie, Marine Le Pen's national rally also missed out on some of their biggest targets. So what does this mean ahead of next year's presidential election?
Yeah, so just getting to the sort of the cities that we care most about, obviously Paris is the sort of crown jewel within France, and that was held by the socialist Emmanuel Grégoire, managed to win that seat, really taking another sort of term for socialists after 2 terms from Anne Hidalgo. So that was sort of the main sort of municipal election that we were watching out of 35 or so thousand that there were across France. But I think the trend across France, what we did see was a rise for the far right, for the Rassemblement National, Marine Le Pen's party, headed now by Jordan Bardella. We did see their popularity increase, but in the second round vote, we did not see them get all the way to the goalpost on many of the key elections in the key cities within France. So it's a bit of the theme we've seen historically within France, where you do see a move to the right, you do see some rising popularity of the RN, and at the same time not really getting that escape velocity in all of these jurisdictions. That being said, they did win a number of different cities, and it will give them an opportunity, which they have not had since the 1970s when this party was founded, to begin governing and get that track record sort of on display ahead of the 2027 election next year, which is really anybody's game, as you know, Francine.
And Ollie, Denmark goes to the polls on Thursday as Prime Minister Mette Frederiksen seeks a 3rd term. What can we expect there?
Yeah, that's right. So they're going to go to the polls tomorrow to vote in the national election within Denmark. She called the snap election in the wake of what we saw with the sort of disagreement over Greenland. This was really sort of a boost for her nationally. Her polls have been dwindling in the last couple of years, but really this would be her 3rd term. So this would be Mette Frederiksen stepping up to the plate to try to get a 3rd term. They have it pretty much on lock. It is very likely that she will win. The question will be what the coalition will be composed of. The main issue domestically has been a reform on taxes, a wealth tax that puts a 0.5% tax on people that have effectively more than $4 million. That has been pretty controversial within the private sector. But from the EU perspective and the national stage, Mette Frederiksen is a sort of known quantity for the Europeans. She's somebody that's been very hawkish, very defending of Ukraine, but also is a sort of interesting model of a socialist who is a very strong socialist and at the same time very sort of strong on immigration policy. And that's a sort of playbook we're starting to see develop across Europe. But likely she's going to win another term when they go to the polls. The question will be in what kind of coalition she'll assemble the government.
Ollie, thanks so much. Ollie Crook there with the very latest, of course, on some of these elections that have been or that will be. Just the Danish election is actually tomorrow, not Thursday, so I stand corrected. Now, New York's LaGuardia Airport will remain closed until at least 2 p.m. local time. That's 6 p.m. London. That's after an Air Canada Express plane collided with a vehicle shortly after landing, killing the pilot and co-pilot. Let's get more from Danny Lee, Bloomberg Aviation and Transport reporter. Danny, thank you for joining us. What more do we know about the incident?
Hey, Frank, good morning. So we know that there was a fire truck that was crossing the runway at LaGuardia Airport late night on Sunday and crashed into a Air Canada regional jet that was landing. And unfortunately, as said, 2 pilots have now died. We don't know any more about the extent of injuries on board. We had 76 passengers on board the aircraft overall. But yeah, this is yet another fatal commercial aviation accident in the US at a time when authorities are trying to modernize and boost safety.
Yeah, and Danny, as you're saying, this is just, it feels like it's just the latest accident hit the US aviation industry in the last 15 months.
Yeah, that's right. I mean, the string of accidents that have taken place, obviously we have to go back to the most notable case, the American Airlines jet that crashed, collided into a US military helicopter back earlier last year, and then also the UPS crash. So clearly there will be a focus on authorities to try and quickly understand what went wrong in this latest incident. We do have National Transportation Safety Board officials being dispatched to the scene. But already when you try to look and understand what has happened, there is some audio on the internet relating to the air traffic controllers being remorseful for what has happened. But it's going to be a key thing to try and get a handle on what has happened, because for now, one of the US's busiest domestic airports will be closed until 2 p.m. That's going to affect many hundreds of flights in the meantime.
Danny, thanks so much. Danny Lee there, Bloomberg's Asia Aviation and Transport reporter. Now, Bloomberg understands that the chief executive of the world's largest oil-producing company has withdrawn from a major energy conference in Houston as he deals with the situation in the Middle East. The Aramco CEO, Amin Nasser, had been due to appear on stage at CERAWeek, but sources say he will no longer take part. Aramco has had to reroute much of its oil because of the effective closure of the Strait of Hormuz. And European Commission President Ursula von der Leyen is visiting Australia this week after she said a trade deal between the two sides is in the final stretch. Well, von der Leyen will travel to Canberra to meet with Prime Minister Anthony Albanese, although it has been confirmed if a deal will be signed. Well, Australia and the EU have been negotiating over a free trade agreement for more than 8 years. And the Volkswagen CEO has told the German newspaper that the restructuring process at Europe's largest automaker will continue even as its order backlog rises. In an interview with Bild, Oliver Bloom has said that to avoid costly overcapacity, the company is applying clear manufacturing cost targets to all of its plants, while Bloom adding that Germany can learn a lot from China, hailing the country's systemic approach with so-called 5-year plan. And finally, Lionel Jospin, the former Prime Minister of France, has died age 88. That's according to the French news agency AFP. Now, during his 5 years in office, which ran from 1997 to 2002, France recorded its fastest economic growth rates in a quarter century, outperforming the UK and Germany. Jospin was also known for introducing a 35-hour work week. While AFP reports that Jospin died on Sunday, it did not immediately provide a cause of death. So, of course, there is quite a lot going on in today's market session. If you look at gold, for example, it's fallen for a 9th day, again, as the war in the Middle East spurred a broad sell-off across markets. Gold actually plunging as much as 8.8% to just shy of $4,100 an ounce. Now, the metal, in fact, has shed more than 20% since the war in Iran began, with part of the losses explaining by a dash of cash for investors ditching their relatively liquid assets. Now, expectations of higher interest rates, but also expectations of a stronger dollar have added to headwinds for gold, with non-yielding bullion looking less appealing, when rates remain high. Amongst the other things we're watching, of course, there's also Brent. It was above 110, also WTI in the U.S. Overall, look, it's, fears of this possible escalation in the war in the Middle East are driving sharp declines in bonds and stocks after the U.S. and Iran seem to be toughening their rhetoric. Tomorrow on The Pulse, we'll have an exclusive conversation with the Telecom Italia chief executive following that takeover bid by Poste Italiane. That's at 9:30 a.m. London time. Coming up, Sheryl Sandberg, the former Meta COO, is on Bloomberg ETF IQ at 4 p.m. London time. Up next, it's Bloomberg Surveillance, and this is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
The moves that we're seeing in the front end of the curve, absolutely nothing shy of spectacular.
The central banks aren't taking any chances.
It is now leaning towards hikes more than cuts.
We still think the next move is a cut.
What's going to happen? And the answer is, we don't know.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, facing an ultimatum. The U.S. threatening to strike power plants unless Iran reopens the Strait of Hormuz, keeping oil at multi-year highs and gas elevated as the war enters week 4. The energy shock morphing into a bond market rupture, sending yields even higher. We begin this hour with the president's ultimatum, posting Saturday evening. President Trump writing, if Iran doesn't fully reopen without threat the Strait of Hormuz within 48 hours, the U.S. will hit and obliterate their various power plants. That deadline just hours away.
13 hours, 44 minutes, according to the president, when potentially we have this deadline, according to him, that there will be a serious escalation if the Strait of Hormuz is not opened. What is so interesting is it came over the same course of the weekend when Friday evening after 5 p.m., the president actually said they were looking at winding down, which is why you have Tehran, Gulf countries, and financial markets, Jonathan, on edge.
In this market right now, in crude, we're pricing higher for longer. This is a change. Let's check it out. Check out the front month of the futures curve and compare it to where December is trading right now. And you'll see the bigger move is taking place at the longer end of the curve. The December contract coming into this war, trading in the 60s. It's now trading close to 90 so far this morning. And the larger move at the very back end of the curve, which tells you at the moment for this year at least, we're pricing higher for longer.
Yep, higher for longer when it comes to energy prices. That potentially means higher for longer when you look at the gasoline pump. I checked AAA this morning. We are just a hair, a smidge away from $4 a gallon across the national average. And all of this, Jonathan, is for the fact that people are starting to wake up and realize even if the Strait of Hormuz does become open, the damage is done. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. It is going to take months to get them back to operation.
We've been tracking this as follows with the following framework. Take the energy shock, push it through the bond market. Energy shock, bond market rupture. Check it out, 2s, 10s and 30s. Yields at the front end of the curve, rising for 5 consecutive days. In 16 trading days, we've had a 60 basis point move, and we're just short of 4% on 2s this morning. Higher for longer in the energy market, higher for longer in the bond market.
You have to think, is this where potentially the president starts to wake up and feel yippee? Remember, it was Liberation Day. It was around these levels when he started to get concerned about his policy. He didn't like this idea of the question of the Trump put, would you reverse policy? The problem he has now is he is only one party to this conflict. And if he wanted to reverse it, he is going to need the Gulf Arab countries to get on board, the Israelis, and of course, another party, and that's the Iranian regime.
We've got a lot to work through this morning. We're kicking off Monday morning with futures, negative 0.75% on the S&P. Coming up this hour, Jeff Yu of BNY with stocks under pressure. Norman Rall of CSIS as President Trump gives Iran an ultimatum. And Michael Hay of SocGen on how crude could hit 150. We begin this hour with our top story. President Trump threatening Iran with an ultimatum to reopen the Strait of Hormuz by later this evening. Bloomberg's Jemana Basenji joins us now for more from Dubai. Jemana, that deadline just around the corner.
Yep, and the entire region is on edge. I will say it was interesting that we heard from the U.S. Treasury Secretary Scott Bessent over the weekend, and he said sometimes it's necessary to escalate in order to de-escalate. But what we're seeing right now is who has escalation dominance. So essentially what we know is President Trump put up that Truth Social post on Saturday evening, 7:45 p.m. Eastern Time, threatening Iran to reopen the strait with no threats. And if they did not follow through on that, then the U.S. would not hold back at striking Iranian plants. Now, Iran was quick to respond the next day, and they said in turn that if the U.S. followed through on that threat, they would then strike back once again at key energy infrastructure in the region, alongside information technology and desalination infrastructure as well. And let me just spend a moment on that, because to what Anne-Marie was saying, if you look back, and the war has been going on for 24 days now, the IEA are saying there are 40 sites, 40 energy sites in the region up until now that have been damaged or severely damaged by the Iranian attacks. They're also saying that desalination plants could be a target here. That would be a game changer for the region, because depending on which country that you're looking at, about 70 to 90% of their water is derived from these desalination plants. So there is a lot of nervousness about whether President Trump is actually going to follow through on that ultimatum. It translates to around middle of the night over here in the region. So we'll see what happens over the next 24 hours. But irrespective of that, I think what's become clear from all of this is Iran have realized the leverage that they have over the strait. And it is not what they say shut, it's effectively under their control. President Trump is trying to reduce the chokehold that they have over it, but with limited appetite from allies to get involved. You know, we've heard from the NATO Secretary General over the weekend, Mark Rutte. They said that they're working on a plan to help assist the U.S. with the maritime mission. But ultimately, the situation we're in now is it is still effectively shut. And as long as it's shut, you're going to continue to see this upward push on global energy markets. Plus, you have to factor in the ongoing damage that is being sustained at many of these energy sites. And even just this morning, ADNOC, which is the main energy operator here in the UAE, they too are saying that they're going to have to start limiting LNG production. So the knock-on effects are continuing. As we head into another key ultimatum, the next 24 hours will be crucial once again.
The pressure is building. Jemana, stay safe. It's good to catch up as always. Bloomberg's Jemana Basenji there, leading our coverage out of the region as this war enters week 4. She mentioned the IEA. Fanny B-roll in the FT over the weekend. Check out this out. Volume of gas cut off is double what Europe lost from Russia in 2022. More oil lost now than the twin shocks of the 1970s. Fanny B-roll calling this, quote, the greatest global energy security threat in history.
It's basically this two-pronged approach what we have right now in terms of LNG being taken offline as well as actual crude barrels, which is why he's saying it's these two massive energy shocks of the past, 1970s most recently, 2022, confounded in one crisis right now.
Here's the view on Wall Street so far this morning. Jeff Yu of BNY writing, investors are increasingly fatigued by the lack of resolution. The risk of further market adjustments is rising, not fading. Jeff is welcome for more. Jeff, welcome to the program. We've seen a major adjustment in energy. We've seen a major adjustment now in the bond market. How far along are we in the adjustment process for equities?
I think no one really knows at this point, and we're looking at EM this morning pretty much given up all its gains for the year. I think the first phase is pretty much done, and what I mean by that is the overheld positions, the high-performing positions, you know, your careers of this world, they have basically given up this year's gains. But that's the first phase. The next phase is now we look at the impact on balance of payments, the impact on margins. Do we move into an outright correction mode where you've not only given up your gains for the year, but you move into an outright loss and a severe loss? I think that's the next phase where markets are looking at, and we just don't know what resolution even looks like at this point, and I think that's where the focus needs to be.
Jeff, many are shaken by memories of 2022, stocks down, bonds down. What are the risks of a repeat of 22 for the year ahead?
So here's where I'm pushing back against market pricing right now. I look at this morning, 4 hikes from the Bank of England this year. Seriously? Right. So I'll just give you one figure here. The UK savings rate right now is approaching 10%. In 2022, it was barely 2.5%, 3%. So households have been retrenching for several quarters now, not just in the UK, but in Europe. The place in the cycle for Europe is very different compared to 2022, where we still had this post-COVID demand expansion. So that's where I think markets are really pushing the envelope a bit in terms of what they think central banks can do. They've learnt their lessons from 2022, 2020. They're saying the right things. So I think central banks are going to be as hawkish as possible without hiking. That, at least, is the impression I got from last week. So I think that's where some correction is needed as well. It's not all doom and gloom, same as 2022.
Yeah, Jeff, I'm with you, because 22 was a shock for the market, not a shock for GDP. This feels different coming into 2026. This could be a real growth shock. At some point, the outlook gets so bad it's bullish for bonds. Are we close to that point?
I don't think we're there yet, because, as you said at the top of the program, they're looking for resolution, but also, you know, what does resolution look like and what does the supply chain look like up ahead? I'm actually, in terms of prices, I'm looking at food prices right now, less so perhaps in developed markets, but in emerging markets, again, what has been a high-performing element. Australia has announced that so one of the ammonia plants, which is key for fertilizer, supplies 5% of the world's fertilizer. That's going to shut down for about 2 months. That's going to have a knock-on impact. India, Bangladesh, these countries, large fertilizer producers, they need it as well. India's asking for fertilizer from China. So this is where I think the knock-on effects could drive inflation higher, not just in EM, but globally, and that will feed through down the supply chain into CPI as well, something we need to keep an eye on. So does that actually introduce capacity to cuts rather than not hiking is something that will be uncertain as well.
Jeff, I'm glad you brought that up, because it's not just LNG and it's not just crude oil, it's helium, it's fertilizers, and you're looking at the immediate inflationary shock of that. But long term, isn't that also a growth shock?
It absolutely is a growth shock, and as you stated, helium, that's crucial. Japan, I think, announced last week they had about, 2 to 3 months worth of helium supplies left. I think markets want to look at how much helium is in South Korea, in Taiwan. Why? Because crucial to manufacturing chips. And if we think about the AI theme, you know, that's really been driving US growth, you know, global tech-based growth. If that starts to constrain this theme, which until now has been like one of the positives for the global economy, if that starts to unwind, then the growth shock, you know, could be larger than expected as well. So again, right now we're in the phase of understanding, you know, what the secondary, tertiary implications are from all of this.
Makes it really difficult to understand the risk reward in equities right now, Jeff. So let's talk about the price of the story. 5%, 6% away from all-time highs. Is that attractive yet to you?
So again, we don't know, where this and how this ends, and we have to define that. So if it's going to be, so put it this way, in terms of scenarios, starting to look attractive, absolutely yes. But if the knock-on supply effects drives up costs over, let's say, a sustained 12 to 18-month period, let's leave the demand side from the household out of the equation for a second. That will impact margins, right? If helium's going to be more costly, if other input prices are going to be more costly, then we have to factor in that discount into equity markets as well. If it's going to be short-term production issues, 2 to 3 months, as has been stated, then I think it's manageable. Anything more prolonged, if we're talking 6 to 12 months, then a discount is needed.
Hey, Jeff, it's got to catch up. As always, Jeff Yu there, FBNY, out of London this morning. We've had the energy shock, the bond market rupture in play, and now we're trying to calculate the growth scare. That's where the market kind of is coming into this week.
When it comes to the growth scare, you need to think of crude oil and how long potentially these high inflated prices will last. And then at some point, does that trickle down to other parts of the economy, to goods and services? You look where diesel is, it is very elevated right now, and that is going to have an effect on a number of issues. And then you take into account helium for semiconductors and fertilizer for plants. This is why this is going to be incredibly difficult for politicians as well as for policymakers.
Speaking of politicians, gasoline basically at $4 a gallon now on average in this country. That's a big change in the last 3 weeks or so. Equity futures on the S&P negative here by 0.7% on the S&P 500. With an update on news worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran is carrying out a fresh wave of attacks across the Persian Gulf ahead of President Donald Trump's deadline to reopen the Straits of Hormuz. Trump delivering an ultimatum to fully reopen by 7:44 p.m. Eastern tonight, after which he's threatened strikes on Iran's power plants. Iran is threatening to mine the entire Persian Gulf, not just the Straits, if the U.S. or Israel attacks its islands or coastline. Here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 13 people were hospitalized with injuries. And the U.S. is deploying immigration agents to airports to help ease delays caused by a budget impasse. Border Chief Tom Homan says the agents will perform non-significant tasks and won't be using X-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks due to the partial government shutdown, leading to lengthy delays at U.S. airports. That's your Bloomberg brief, John.
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the program, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
A conversation up next with Norman Rule of CSIS, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Three-day slide on the S&P becomes day 4. Equity futures negative by 0.8% following a fourth consecutive weekly loss on the S&P 500, the longest in more than 12 months. The epicenter for the pain, you know it well, crude, WTI and Brent. WTI overnight trading in triple digits, 99 so far this morning, up by 0.9%, up on the month by 40 to 50%. And this stock down on the month by something like 15. United Airlines, the corporate reality check going into the weekend. United put out a statement. Got lots of cash compared to COVID. Balance sheet's good. Demand is tremendous. But take a listen to this from them. Jet fuel prices have more than doubled in the last 3 weeks. If prices stayed at this level, it would mean an extra $11 billion in annual expense just for jet fuel. For perspective, in United's best year ever, we made less than $5 billion. The warning from the airlines.
It's getting very expensive, and this is a warning from United Airlines here in the United States of America. These warnings already came almost immediately in Asia from some of their airlines because they feel the energy shock first. They are front lines of energy shock. And now for the airlines, it has gone global in terms of how much more expensive they realize the jet fuel is going to be. You know what that means, Jonathan? Higher ticket prices.
They're planning for the worst and hoping for the best. Bramo will have more on United Airlines when she's back with us tomorrow morning. Look out for that. Under surveillance so far this morning, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. And now General Kane, Secretary Xauusd are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Sometimes you have to escalate to de-escalate.
So here's the latest this morning. President Donald Trump giving Iran an ultimatum to reopen the Strait of Hormuz or have its power plants bombed. And Iran launching fresh attacks across the Persian Gulf just hours ahead of that deadline later this evening.
So they're launching French attacks, and they're remaining very defiant in terms of some of the rhetoric we are hearing out of the country. So they are saying that all energy, information technology, and desalination infrastructure belonging to the U.S. and Israel are targets. They are saying that also they will completely continue to close the strait if this continues. And then this one, Jonathan, caught my attention. The head of Iran's parliament says that any U.S.-linked financial institution holding American government bonds, U.S. treasuries, would be targets alongside military bases. So potentially what they are saying is that if this were to come to fruition, they would start attacking banks in the Middle East and to American partners and Arab partners and Israel if the president comes through. With this ultimatum he has.
This has been a feature of the past 3 weeks and change. When we say Iran, who are we talking about? Who actually has a voice? Who is leading this effort right now, this response to retaliation we see across the Gulf? That one person? Someone else? When we say Iran, who are we talking about?
That's a great question, because when the president is asked about this, he says he doesn't even know who is running the country. Obviously, we have the new supreme leader. He is injured, according to reports, and we have not seen him, even though we have had Persian New Year. Normally, traditionally, you would have this video statement or speech from the supreme leader. We only got a written statement. So that is very curious. But when you look at when it comes to the regime, head of parliament, the foreign minister, the president, all of them are out front.
Here's the take from Norman Rule, the former senior U.S. intelligence official and senior advisor at CSIS. He writes the following. If the U.S. executive executes strikes on Iranian power plants, civilian infrastructure would become a primary battlefield and oil would reprice sharply for an extended disruption scenario. Norm joins us now for more. Norm, welcome to the program. Can you help set the stage? What are we set up for later this evening?
Good morning.
So 3 weeks into the conflict, a new battle space dynamic has been created. Despite the extraordinary campaign results of the United States and Israel, the Iranian government has survived. So the war has evolved from a Gulf shipping and gas infrastructure crisis into a deadline-driven strategic depth and civilian critical infrastructure contest that openly involves control of the Strait of Hormuz with all energy systems, regional power infrastructure, desalination systems within a potential escalation envelope. Once these systems become explicit targets or even threat objects, you in essence have a situation where the market will now need to price in not only the crude and liquefied threat to natural gas, but also reliability of electrical systems, water security, repair times, and the higher probability of allied burden sharing of all of the Gulf Cooperation Council partners.
Norm, when the president puts out a statement and has this ultimatum about opening up the Strait of Hormuz, or he's going to go after power plants, do you think that statement would come from the President of the United States if he was unwilling to do so?
No, I believe the President of the United States has a serious intent of taking a greater action against Iran. I also believe that U.S. Forces in the region are more than capable of executing the President's wishes, but they would prefer to undertake these actions when the conditions are most appropriate. Now, they can do whatever the President requires. Fully opening the strait would require a reduction of Iran's UAVs, its drone threats, and probably undertaking more action against the Strait of Hormuz's Iranian infrastructure, and waiting until we have the full contingent of additional Marines and perhaps some additional air assets.
Norm, you've been in the room. The president will have a number of options in front of him. There's reporting over the weekend that he mulls Karg Island, a takeover of that island that's just some miles off the Iranian coast. Can you go through all the options right now you think are being presented to the president?
Well, I'd prefer to avoid all the options, in that perhaps the Iranians are watching, and giving them a school answer may not be the best of ideas. But it's likely that the president's overall approach is to convey to the Iranian government that they're about to lose control and the revenue from their most strategic asset, and that idea is going to ripple through the strategic leadership of Iran's government and compel them to push for negotiations and to make concessions on several points, which is in essence to give up the idea of nuclear weaponization, the enhancement of their ballistic missile program, the Quds Force activities within the region, and to return the Strait of Hormuz to international control, vice their control.
No, there is some speculation that a ground operation could be imminent. Can we go into the realm of speculation together and talk about the geography, a geography that you know well? How difficult would a ground operation be in a place like Iran?
Well, I'm not sure the issue is of difficulty. U.S. forces are extremely capable. All ground operations have a lethal component, and no one should diminish the threat to U.S. forces. I think you want to ask instead what the ultimate goal might be. What is the purpose? Are we trying to retain territory? Are we trying to send a message to Iran that we can take territory? Are we trying to destroy key facilities? The question is, what message are you trying to send to the Iranian leadership? We've already sent the message that we can destroy anything in Iran. We can control any physical space in Iran. We control the skies, which means we control the ground.
Norman Rowe with CSIS. Norm, thank you, sir. Appreciate it. Of course, the objective at the moment of the conversation, taking Karg Island.
Absolutely. That was the reporting over the weekend, that this is what the president is weighing, potentially going after Karg Island. We've already hit, the U.S. military has already hit military installations on Karg Island. Potentially what would be next was taking control of it and then having complete control of the Iranian economy lifeblood. 90% of their crude gets processed on that island.
We often have this conversation. The president backs out when things get tough. Backs away, changes course. Saw it last year. According to so many people in this market, gasoline prices getting closer to $4. No sign of him backing down. Massive moves in rates over the past week. No sign of him backing down. Conflicting statements, yes. A conflicting statement going into the weekend on Friday after the closing bout. Then he said something else on Saturday evening. But ultimately, no real sign that the U.S. military is backing down and backing out.
So Friday after 5 p.m., when I saw the markets close, and then I also, of course, saw the president's truth, I thought maybe this was the moment he wanted to back down. And then that was completely reversed with his next statement saying that there was going to be this ultimatum to the regime. You need to open up the Strait of Hormuz, relax your control. You know, you have to let every vessel in, not just the ones that you deem friendly, or there is going to be serious consequences. So right now, that is why everyone is on edge.
Right now, futures negative by 0.9% on the S&P 500. Up next, Michael Haig of SocGen on why time is working against oil markets. Plus, Yahara has your morning movers. Mining stocks sinking as the war in Iran weighs on metals.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
For the last 3 weeks, every Monday has started Sunday evening, and it started with this. What's the price of crude? This is the price of crude. WTI and Brent. WTI briefly, triple digits, 99 this morning. Brent crude, let's call it 114, a 50% move in 16 trading days through the month of March. Amazing. That's the energy shock. Here's the bond market rupture. Huge moves at the front end of the curve as we price out easing and begin to price in hikes in certain countries. Stateside, just short of 4% on a 2-year yield, up by 60 basis points in just a few short weeks. And In the UK, up more than 100. That's a major, major bond market move. That's the bond market rupture. Now let's talk about the potential growth scare. On the S&P 500, down every single week so far this month. We're down 5% from all-time highs. Within the S&P 500, refiners up by 17%. Consumer discretionary down by 7%. To what extent have we repriced growth sufficiently for the shock in energy and the shock in bonds?
And you know what, Jonathan? It's not just the shock in energy. It's not just potentially that gasoline prices are going up. We are just there when it comes to $4 a gallon of gasoline, just a hair away, and I imagine it's going to hit that tomorrow. What happens when all this starts to creep through the supply chains? Your food costs, other goods, potentially even services becoming more expensive. And you have to think, central bankers around the world, remember just what happened in 2022 when they said this inflation was transitory. Is it, or is this going to be more engrossed in the supply chain?
Big question for Governor Marin of the Federal Reserve later on this morning. The biggest dove on the committee is going to join this programme at about 8:45 Eastern Time. His first conversation following that dissent, that push for a 25 basis point interest rate reduction at the Fed's last meeting. What's the argument now for lower interest rates with the market pricing in higher rates?
I imagine the argument he will make is actually that this is, and it's not a good one. No one wants to hear that this maybe potentially in the short term is inflationary, but you are that concerned that it is going to be an economic shock to the supply chains, and it's going to be lower growth and maybe at some point for some of these companies, layoffs.
Governor Marin, 8:45 Eastern Time. Don't miss that conversation as we count you down to the opening bell 3 hours away. With your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We are seeing mining stocks under pressure this morning as they track gold's decline, down for a 9th straight session and coming off of its biggest weekly drop since 1983. And in silver, we are seeing an even sharper move as you're seeing how rising yields are pulling money out of the precious metals trade. And no surprise, as you gave that market check on oil, that we are seeing oil stocks surging this morning as we continue to see oil push higher. Brent up for a 5th straight session with no de-escalation in sight when it comes to this war. As we've been talking about all morning, Iran striking sites across the Persian Gulf, even as it faces that ultimatum by President Trump to reopen the strait by tonight. And I will say Cheniere Energy is benefiting from an upgrade by analysts at Morgan Stanley, so that stock outperforming up 4.3%. And another bright spot in this market is Synopsys. Shares are up 1.6%. On reporting that activist investor Elliott Management has built a multi-billion-dollar stake and is now pushing the company to better monetize its chip-making software, because this is a business that is at the center of the AI build-out, yet has not kept pace with some of the broader chip names. John?
Yahira with the latest. Yahira, thank you. More from Yahira later this hour. On our radar this morning, Iran threatening to lay mines across all routes if the Persian Gulf is attacked by the US or Israel. Iranian officials saying, quote, the entire Persian Gulf will be practically blocked. Elsewhere, Iran carrying out fresh strikes across the Middle East in the hours ahead of President Trump's ultimatum to fully reopen the Strait of Hormuz. The UAE reporting new drone and missile attacks overnight. And finally, US allied countries pledging to lead a multinational effort to help secure the Strait of Hormuz.
22 countries, most of them NATO, but also Japan, Korea, Australia, New Zealand, Bahrain, the UAE have come together to answer the president's call to make sure that we secure the free sailing through the Strait of Hormuz.
President Trump previously blasting NATO allies for failing to act, with Rutte saying it's only logical European countries need a few weeks to come together.
So right now they're talking, and he talked about how he is in constant conversation as well with the president. But to that last point you made, Jonathan, this comes after the president blasted NATO allies and saying that NATO is nothing but a paper tiger without the U.S. involvement. Now you see the European allies and some other Asian allies talking about it because they might not have a choice. If energy prices continue to go higher, they might need to do something in terms of this coalition to try to reopen the strait.
It really hasn't been a great start to the relationship between NATO and the US. And I would be more specific, I would say European partners and the United States. Going after Greenland the way the US did at the start of the year, I think upset a lot of people. The comments on the way out of the World Economic Forum questioning how committed their allies were 25 years ago in the war in Iraq and in Afghanistan, and the amount of tours that individuals did, NATO allies, that fought on the front line, shoulder to shoulder with US military officials, and yet the president questioned whether they were on the front lines at all. And here we are. We don't need NATO, we need NATO, we don't need NATO, we need NATO.
It's a little bit confusing. And to that point, this just might be too much for European allies, especially British troops, which did a tremendous amount of work in fighting alongside American troops in Iraq and Afghanistan. You also have to remember, I believe it was the Vice President, J.D. Vance, who told European allies, this is an individual who obviously has been very critical of the Iraq war under Bush, has said maybe it was the European allies should have had more of a stronger backbone and stepped up to the United States. Well, I think some capitals in Europe are actually saying, we have our backbone, we don't agree with this Iran war, and maybe that is why we're not going to send this coalition.
Let's stay on the energy story. Crude hovering around multi-year highs. Michael Haig of SocGen writing, with each passing day, the market grows more strained. With no resolution in sight, prices could climb towards $150 a barrel in April. Michael joins us now for more. Michael, welcome to the programme. Your note was one of the first notes I read to start the week. Scenario B. We're very close to what you call Scenario B. What was Scenario A, and what does Scenario B look like?
Scenario A, first of all, good morning. Thanks for having me. Scenario A was our base case scenario at the start of March. The market was pricing in a very quick resolution to this conflict. So our scenario A was that we see the straits opening up by the end of March, but prices getting up to $125 a barrel. Looks like we're going to have to adjust that, move to scenario B, where we have this conflict continuing through April, and that brings oil solidly up to $150 a barrel.
Michael, are you now pricing higher for longer? That's not just a short-term story, that's a long-term problem?
Yeah, unfortunately, that seems to be the case, because every day that goes by, oil taken off the production makes it harder to come back. Obviously, infrastructure gets more and more damaged. So, yes, higher for longer, I'm afraid.
Michael, this was an issue for the equity market, the issue. I think the source of comfort was we had extreme backwardation in the futures curve. Yeah. And for people who aren't in your world, that just meant the front month of the futures curve was really elevated, but the market was pricing a short-term problem, and we had this steep drop-off through the rest of the year. You see this playing out this morning, the opposite. We're starting to lift the back end of the curve, starting to price in the higher for longer scenario. Michael, this raises the question of demand destruction, so-called demand elasticity. What are the realities for the energy market? When does that destruction creep in?
So, well, there's one thing to not being able to afford oil because the price is too high, and the other thing is not being able to get the oil, and that's the bigger concern. So, generally speaking, from a price perspective, and when we talk about demand elasticities, the oil market is fairly inelastic. That means that when prices go up, people really can't change their behavior that much. So, given the fact we've had about a 50% increase in oil prices since the end of February, that would ordinarily mean, from a price perspective, you would lose about 1.2 million barrels a day of oil demand as people can't afford it. If we go to the $150 scenario, then we'd be talking over 3 million barrels a day of oil demand destruction because of the price effect. But as I mentioned, it's not really just about the price. It's about that some countries can't get the oil. So you're already seeing airlines put on surcharges, cutting flights. You see refineries in China cutting their runs. You see ethanol crackers cutting their output because they can't get the feedstock. So there are some countries in Southeast Asia that maybe have 15, 20 days of oil and product in inventories. So we're going to get to a situation potentially where we get demand destruction because these countries can't operate as normal.
Michael, to that point, we have SPRs around the world. Different countries have their own strategic reserves when it comes to crude. Are you basically talking about the fact that we might have the crude, but it's so dislocated in the market right now, there's not going to be enough refining capacity to, say, turn that crude to diesel or jet fuel?
Yeah, I mean, we're talking 17 million barrels a day that has been displaced. I mean, if you look back historically, we've basically had 30 geopolitical conflicts since the early 1970s, and the next biggest disruption to supply was all the way back in 1973 when we had 7% of oil being removed because of the Arab oil embargo. Now we're talking 17% being removed, so it's a massive difference. So, you know, all you need to do is take that 17 million barrels and say how much can be redirected through pipeline, how much can be we offset through demand destruction, how much can come from the relief from Iranian sanctions on floating oil, et cetera, and you add it all up, and you still have a massive deficit of around 8-9 million barrels a day. And that means that can't get to the refiners in Singapore, elsewhere. They can't create the product, and that creates the issue for gasoline, jet, diesel, mainly in Asia.
Michael, the way you talk, I'm thinking this is not going to be months. This sounds like a multi-year recovery. Is that accurate?
I don't think it would be as drastic as that, but as each month goes by, we're talking several more months to recover. The market's very resilient and it'll bounce back, and there is plenty of oil out there in terms of spare capacity, generally speaking. So, if by some miracle this was resolved tomorrow, and all the oil came back into the market, we might lose like 1 or 2 million barrels a day because of the shut-ins, because of infrastructure, etc. But generally speaking, going into this, we were in a surplus of, let's call it, about 3 million barrels a day. So fingers crossed this doesn't go on through past April, because I think if we can get through that, by the end of the year, we'll be back to kind of normal.
Michael, this is starting to creep into base metals. Let's just turn from energy to things like aluminum, to copper. We're starting to see some big moves there as well. How far along do you think we are in the process of trying to understand how cyclical the demand for those metals actually is at a time when a lot of people are getting bulled up on these secular tailwinds coming out of technology?
Well, I think, let's think about copper here. I mean, we said before this conflict that there was some unusual demand situations going on in those metals markets, given the growth of AI, etc., but also because of strategic stockpiling, because of military spending. So I see a very bright future for those metals from that perspective, because coming out of this conflict, I still believe there'll be a push to do more strategic stockpiling for things like copper and aluminium, just like we have for oil. We'll see more military spending. That's very metal intensive. So, despite the fact that they get pulled down because equities get pulled down, I think their future's pretty bright.
Can we finish on gold? Michael, 20% move so far this month. Huge, huge move. What do you think's behind that move? Is it just an interest rate move driving people out of gold? Is there something else at play?
So I think what's going on there is that we don't have any central bank buying right now. I don't think there's any appetite to do that, where countries are squarely focused on getting through this energy crisis. I wouldn't be surprised to hear reports that some central banks have sold gold in order to subsidize some of the energy issues that they have in their countries. So it's been a big pause, I think, in that buying. That's mainly the reason why we've seen it sell off. ETF flows by themselves couldn't explain the dramatic decline in the gold price that we've seen recently. Of course, some of it is fundamentally based on interest rate expectations, etc. But again, a bit like the base metal complex, I think once we get through this oil situation, and with gold prices where they are right now, I would imagine central banks resume their buying.
Michael, good to see you. Thank you, sir. Michael Haig there of SocGen, working through what's happening in energy, what's happening in base metals and precious metals. Gold down by 5% on the session just today.
This is so interesting when it comes to gold. All these central banks that were hoarding it up. Well, why do you do that? For a rainy day. And potentially they are the ones that are right now out there selling because they need to move funds around in their government to help when it comes to the energy shock that their consumers are facing.
Right now it's pouring with rain, that's for sure. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Iran has until 7:40 p.m. Eastern tonight to open fully the Strait of Hormuz, according to a threat by President Donald Trump. The president saying if Iran does